Okay, we'll call this meeting to order. It is 10:03, and we do have a quorum presence. And we have Clips here and Will and Mr. Buckingham and myself, and then online we have remotely there's Melissa Curtis, Brad Wright, and Mackenzie and Jim Stanislaus. Welcome, everybody. And welcome to the first quarter meeting of 2026. And so our first item of business will be the minutes of the December 4th meeting. You should have had those in your diligence. Any corrections or additions to the minutes? Right, we have a motion to adopt the minutes. Okay, that's second.
Second.
All right, got a motion and a second to adopt the minutes. Any objections? Hearing none. Minutes are adopted, and we'll go to item number 2, and that is the report from our Chief Executive Officer, Bob Borden, concerning the investment management and administration of the Texas Public School Corporation. Borden.
Thank you, Mr. Chairman. Before I start, as kind of a point of executive privilege, we've been instituting a habit in all of our major internal meetings designed to build and reinforce our culture. And it's the reading of the value statements. And usually those are led by Stu Bogler. So I'd like to ask him real quickly to maybe do that.
Yeah, I will do that. So our values are in every meeting room here in every office. And I like to start our internal meetings reading them. And this is an internal meeting plus 3,000 other people, which I like to remind myself of before I start talking. Let me read you our values and tell you why they're important. Stewardship. We fulfill our fiduciary duty by making prudent decisions consistent with industry best practices. We're here to make money for the school children in Texas, and that is our #1 priority. Never forget. Integrity. We uphold unwavering honesty and transparency in our actions, fostering a culture of trust and reliability. We tell the truth and we share and we challenge each other. Competence. We strive to have a high level of professional training, skills, experience, and knowledge. We want to be best in class running the money for school children in Texas, and we demand that from our employees, and we demand they continue to grow and learn and be best in class. Effort. We seek to achieve continuous improvement in all our processes. As I said, best in class. We never stop. We work hard here. We're serious about what we do. Results. We emphasize the importance of outcomes that contribute to our mission and vision. We want to generate growing distributions to the school children in Texas and maintain a AAA credit rating and guarantee school loans. That is why we come to work. And collegiality. We create an environment that fosters collaboration, teamwork, and creativity, yet challenges employees to reach their full potential. It is a challenging environment. We're not on a camping trip here. We're respectful of each other. We share information with our board. We share it internally. We share it with our stakeholders. And we challenge each other to be great. And our goal here is to be great. And you'll see in our meeting today, we are making progress on that goal. Those are our values. I think of this as a motivational speech before every meeting, why we're here. And in particular, why we're here and how we serve the school children of Texas. Now we get into our meeting.
Thank you, Steve. I look at that as becoming our corporate pledge of allegiance, if you will. Okay, this morning, my high-level objectives is to share the recent progress against our strategic plan, review our fund performance, provide an update on this ongoing credit rating and bond guarantee program issue we've been working on feverishly for the last 6 months. Set the groundwork for a following presentation by NEPC and our risk group designed to, the most important thing in front of you today is approving our asset allocation changes, benchmark adjustments, and other language changes to the investment policy statement. This high-level summary of how we're doing is, continued momentum across all 6 of our goals. We've been fortunate that the markets are continuing to provide a tailwind to us during this really transformative period with a lot of transitions going on. I think we've been very fortunate not to be in run into a high level of volatility and crisis, notwithstanding some of the, tariff blow-ups that have shocked the market, but quickly recovered. We have really put a high level of effort into improving our relationships with the credit rating agencies and better understanding the mechanics of how they rate us, so we can make sure that we are meeting our mission to provide AAA financing for all of the school districts of Texas. And recommending we approve this policy. I think when evaluating later today, I'll distribute my self-evaluation to the board to consider over the next quarter. And I thought the best way to frame those are always going to your strategic plan. And number one is our mission, and our mission to provide exceptional risk-adjusted returns so we can have permanent and increasing funding for school children, while at the same time reducing borrowing costs. Clearly, we've been doing that. Two years ago, we recommended an increase to the 5A distributions to a record high. I think we're going to be in a similar posture this summer. And we have not only reaffirmed our AAA rankings, AAA ratings with the rating agencies, but we have gained a vast amount of understanding in their processes and their models, which is going to help us better manage our investment portfolio with an eye always on that AAA rating. Our vision, though, is fourfold: being a magnet for talent, a leader in the endowment space, a partner to Texas universities and corporations, and a source of more perpetually increasing funding. I'll talk about these for a second. Last being the source, I just discussed that I think we're in a position that we can hopefully increase it yet again for the coming biennium of years 2028 and 2029. The magnet for talent, though, it started with landing a deputy CIO, Stu Bohart, who was former president of Morgan Stanley Asset Management and a partner at Fortress, an exceptional hire for a public fund in transition like us to land him, and then recently building out that C-suite. Lane Arnold had a Harvard economics undergrad degree and law degree from SMU Law, and experience in the large public funds in the state. Lastly, UTIMCO. And our chief operating officer, Nidhi Vasavada, comes to us in a new role we created, and she is both a BBA and MBA at University of Texas with high honors, and has a Juris Doctorate from Georgetown, magna cum laude. Our newest hire, Chris Eckerman, I think he's wrote the name. Chris Eckerman, we just hired to run the co-investment program here. He designed and built and executed the co-investment program at the $178 billion State of Wisconsin Investment Board. And he too is a UT undergrad and MBA with honors. We are starting to see more and more applications from some of the largest endowments in the country and some of our strongest peers. So I think that is something that I don't believe was really ever the case in the longer history of the PSF. But we have, I think, definitely starting to see this vision come to reality, that we are being a magnet. Being a leader in the space can be defined in many ways. I think we're just starting there. Start with showing that we can develop and realize investment returns that are just as competitive with the largest endowments in the country, and we've seen a market improvement there. Being a partner with the Texas universities and corporations and industries, we now have 6 universities engaged actively in an internship program. We just finalized hiring our class for spring and summer interns. Have about 15 interns in different disciplines around the organization both in the investments group, but also in, the legal and finance and audit and the like. We plan to continue to grow that network of other universities within the state. And as we've said before, we have placed, almost $30 billion since I came on board, half of our assets with Texas headquartered or firms that have significant presence in the state of Texas. So I would argue we are certainly off and running and being a partner to these groups. Page 5, I believe it is. No, it's now 6. It's now 6. I can see it. This is a new slide you haven't really seen before. I think it's well.
Can I ask a question?
Oh.
Or do you want me to wait to the end?
Let's just wait to the end. Just hold your questions.
This is really the life cycle of our build out, if you will. I characterize this challenge that I took to a lot of people as a 180-year-old, $60 billion startup, because the new corporation that was created by Senate Bill 1232 not only started with a newly reconstructed board, but lifting the investment team and certain assets out of TEA meant we had to build out all of our support groups in HR and IT and accounting and the like. And with this new board, building, our governance structure. And so our focus has been really creation of a lot of things. Creation of policies to establish governance, the early recruiting of talent that I just referred to, building relationships for the first time as a corporation with legislatures and advocacy groups and the public education community at large. I think most importantly internally is creating and disseminating our corporate culture anchored in this vision and values. And we repeatedly drill this into all of our daily operations here with our staff and live it. And anybody in this organization down to the intern, is empowered to call out any colleague who is not adhering to those values, including myself. I think I put a line here. It's not, a granular timeline, but we are getting to the end. I guess to quote Winston Churchill, right? It's not the end, it's not the beginning, but maybe it's the end of the beginning. And I think that's where we are. We're at the end of the beginning, and we will pivot to this middle column, which I think is probably a longer duration. If I was drawing these with a real timeline, I'd say, that this is going to be the devil's in the details, a lot of heavy lift, but we want to cement our corporate cultures. We want to make it such that, we will not revert back to any, old bureaucratic habits. And we want to embed the governance and compliance and internal controls that we have now created. We want to make it just second nature. Probably the biggest activity that I see that's going to make the most difference in this organization over the next 3 to 5 years is the careful recruiting of top quality team from the internship level to some of these senior folks, but where we take a very measured and deliberate approach and not be in a rush to fill positions, unless we have the right people, the best that we can get, that not only have the talent and skills, but display what we think are the values that we hold dear. And the development of all of the staff needs to be part and parcel of what we do. We initiated training programs to baseline all the technical skills of our current staff. We're trying to hire very skilled people, but we will make sure that we are reinforcing all the training for all the staff. So everybody is current on the same level of skills and technology. With the advent of AI right now, there's a lot more to learn. So we're in a new era of training and education, and we're at the perfect facility and program to do that and take advantage of it. And that's where I think this transition is really going to institutionalize a lot of the ideas and principles we've set out over the last 2 years. In terms of just recent progress on the strategic goals, and I think what's next, on the first goal of asset allocation, we had largely completed the original transition plan set forth 2 years ago. We have recently updated the asset allocation model assumptions, forward earnings, and mixes that will be on your agenda shortly to discuss, as well as the benchmarking study. And we now are developing dynamic credit rating protocols, including having the asset allocation that is presented to the board for approval today has been reviewed by all three of the major rating agencies and concurred that that asset allocation would still hold up to a AAA credit rating. Well, that's never been done before. So we're being very proactive there. What's next in that arena? We are going to kind of start a collaboration effort in 2026 with the TEA, starting with a summit meeting on March 13th. One of our end goals there is to review and modify the memorandum of understanding between the two entities, particularly as it relates to the bond guarantee program, to provide a better feedback loop amongst both parties as to pacing of new issuance and, pressures, that we face in maintaining that AAA rating. I think that's going to be very helpful. If the board approves this new asset allocation, we will feverishly get to work on implementing the transition plan associated with that. And as we get ready to present to both the Board of Education and this board this summer and fall of 5A and 5G distribution recommendations, we have been reviewing and improving significantly those models to back that out. And lastly, on asset allocation, another topic to talk about today, but we will be building out risk modeling and reporting protocols, particularly for the board. We need to build a lot out for internal committees and staff too, but with an eye towards, dashboards for the board in terms of risk positioning and be responsive to Member Thomas's ask of Q3 that we develop kind of a crisis management plan, an emergency plan, if you will, on how we're going to raise liquidity and how we're going to be able to be opportunistic if we are in the middle of a market crisis. So those are the priorities on that goal for probably the rest of this year. On the goal 2, the implementation, we've come a long way. As when I was being interviewed, I said, one of the first things we need to do was tackle the multiple layers of fees, the over diversification, a lot of the fund to funds. This is a long and difficult process, but we have made incredible progress there, and everything that can be unwound has been, and what takes time is underway. But that's resulting in cost savings, which goes right to the bottom line. And we are redeploying those assets in expanded strategic partnerships that are driving much better economics, discounts, deal flows, opportunities for co-investments and seeding and the like. And we've strengthened our due diligence process by creating a subcommittee, if you will, of our investment committee that kind of standardizes all the due diligence materials before they get to the investment committee proper. What's next? The public equity program, including absolute return strategies, is an area that we have to really re-rationalize and redesign. Stu Bohart will be leading a presentation later this morning about that, and you'll see we've got a good vision coming together, but we have a lot of work to do there, both in design and in recruiting. Also building out this new centralized co-investment and direct program under Chris Eckerman. What we want to do is make our due diligence standards and our qualities uniform across all deals. So whether a co-investment originates in private equity or real estate or private credit, we will have one group that does the rigorous underwriting of those opportunities to make sure that we are, applying a very consistent set of disciplines in valuing these things. Beginning of a long-term program is an overhaul and relaunch of our venture capital program. While generally speaking, private equity program has done well, the venture part of it is not. It's It has been a disappointment, and we are going to step back and really redesign and rationalize that subset better. In our human goals, I would say the attract and retain talent and communication goals. Talked about the recent hires. I don't need to repeat that, but we are launching an executive management training program right now for the entire C-suite. And as we develop and refine that executive training program, we're rolling out a management training program for all the mid-level managers behind that. The other things that are next, I've already talked about, are recruiting and communications. We've hired a communications coordinator to help centralize the messaging and consistency. I hope the board has noticed some level of improvement in the quality of and consistency of the reports in front of them over the last 2 years, because we've worked awfully hard towards that goal. But we have realized that we need, a centralized quality control area to make sure that we are doing things both timely and not too rushed to where we are losing, just good flow and accuracy in all of our documents. And so this is going to help. We had commissioned a study of what the University of North Texas did for us on our internal communications process. They had a lot of recommendations. So what's next? Implementing the recommendations. Obviously, we're going to get out in front of the legislative leaders and staff here this spring and summer as we get, our appropriations requests prepared. And we are also adding into our training series, presentation skills training series. So we literally are building a permanent school here. We have technical training, management training, presentation training, and we'll keep adding to that. We've also been very active in health and wellness training as well. In communications, we're holding regular town hall meetings and what we call kind of fireside chats. In fact, last week, Stu emceed a meeting that we had. Robert Merton, a Nobel Prize winner in an options pricing model, spoke to our whole team, and we kind of have a fireside chat, if you will. Progress and what's next on the what I would call the control goals, the oversight goals, the strengthen corporate governance and simplify internal controls. Obviously, we have been just lifting policies all of the last year. We started on the governance policy in December of 2024 and approved it last meeting, December 25. We redesigned the ethics policy and we redrafted the investment policy before you today. What's next? We'll kind of start tipping the cards on that, is possibly revising some of the board committee charters, developing this board risk reporting framework, and implementing metrics that we can use to better quantify plan progress. Key performance indicators and things that some of you all are familiar with. And the internal controls, proud to say, we got finalized in late December our second clean audit opinion from KPMG. And we have, for all of the compliance items that we have put in our new ethics policy and in other policies, our legal team has gone back and pressure tested our reporting of compliance, both staff members, board members, vendors, and we have 100% completion of all required reports. Right up next on deck is the development of our legislative appropriations request. Part and parcel to that is refining our budget preparation and tracking. I expect the quality of this appropriations request to be a quantum leap from what we did before, because now we are linking this to a plan and good budget tracking, and that is what informs the budget. It's just the appropriations request. It is not come up with in a vacuum. And in reporting, one of the items in risk that we're going to have to develop is leverage tracking protocols. That is, leverage shows up in many different forms in many different places. And finding very efficient tools to capture and quantify that is going to require a good bit of effort. That is the status of the strategic plan of what's been accomplished and what's up next. I want to talk about investment performance for just a moment. I've said we've got the decent tailwinds. The economy is dealing with some of the disruptions in tariff policy and kind of digesting it. There's should be some tax cuts and lower borrowing costs that came out of the OBA. I don't want to say the long name, to deliver the fiscal stimulus into the system that should give us some tailwinds. But we are seeing higher volatility, and we are seeing tightening spreads. We will talk about in a minute the going forward returns, but the major indicators we're looking at: real GDP is positive, corporate earnings is positive, inflation has been sideways, and the unemployment rate is creeping up. Net, it's a slight positive. But when we look at the equity returns in these capital markets, this really sets the table for what you're going to see in the asset allocation study. The returns, we've been very blessed with returns from these capital markets. I've got the 1, 3, 5 years and some of the major liquid markets that we look at. When you look now 1 year, I mean, you see some really consistent returns. I'll highlight something though. The S&P 500, we made almost 18% last year. The 3-year annualized 23%. That's not a cumulative, that's 23% per year. And the 5-year annualized 14.5% per year. If we expect, say, 7 or 8% as the long-term expectations in equity markets, and you've been running at high teens, low 20s, it stands to reason you are going to have some below 7% return periods going forward. We regress the mean, and we are consequently lowering some of our return expectations to reflect the fact that the valuations have run up. It's a two-edged sword. On one hand, lowering our return assumptions would have a negative impact on distributions, but those high returns that led to us lowering them have compounded in a larger asset base. So when that larger asset base applies that lower rate, still resulting in potentially higher distributions. The fund itself has continued to perform well. This is a really nice pattern, to be over 3, 5, and 10 years, being that it's positive, that it is above our expected rate of return, and most importantly, above our policy benchmarks. This is a snapshot I might long for 3 or 4 years from now, after we go through a crisis or two, to remember the good old days when it was nice and steady. But here they are, and there's something to be thankful for. The changes we've made, though, to become a leader in endowment management, we're a long way from that. But you've got to stop being a laggard, and we have clearly done that. And that's the first step to becoming a leader. And we hope to. This is the relative peer group rankings, in percentiles, 100 being best, 1 being worst. You don't want to try to strive, I think, to be in that top 10%, because you will have to take bets so far afield from your peers that you're going to run the risk of being in the bottom 10%. Where you can consistently live is in that kind of third quartile, where you have an asset allocation that's in the ballpark of your peers, but through superior implementation, better alpha generation, lower costs, and the like, you can live in that kind of 60th, 70th percentile. And that's what we hope to achieve over a long period of time. The increased engagement with the rating agencies, I don't really have much more to add about this, except to say this gentleman to my left, Jared Stout, has been doing a yeoman's duty in engaging, along with his team, these rating agencies in a way that's never been done. And it requires both technical proficiency and brilliance, and a diplomatic touch. Because, they have their methods that have been developed over many years for many reasons. And you have to have very cogent arguments and, clarity of thought to have successful outcomes in engaging with them. And a matter of fact, I must say, I'm shocked at how much progress has been made in a short period of time through that effort. It's refreshing, and it's going to serve us very, very well. Mr. Chairman, that was the end of my prepared remarks. I'm happy to answer everybody's questions.
Yeah, and I'll just make a comment, and then we'll take questions. Is that, really, the whole liquidity issue is what was really sort of the anchor chain that was dragging this thing down, and just I guess the refusal to think that we could actually qualify that and do that. Bob and his team have demystified that. And we were really, I will tell you that back in December, we thought that we were on the cusp of a crisis with that, because is that what was happening with that is that even though the statute gives us, we can guarantee it to 5 times value. I think SBOE rule was at about 3.5, but we were actually about 2.5 with those limitations just in terms of that. And so, Bob, that's that was a massive Rubik's cube that had been installed that had been really the problem with this fund for a long time that kept it under. So, okay, with that, questions. I know Mr. Hickman, you had a question.
Yep. First one is on page 4 in the vision, Bob. It's be a partner of the Texas Universities, corporations, and industries. Can you just give a little flavor of what that means for the PSF?
Well, it's multifaceted, right? We obviously we know the universities and companies and industries are, but how do we truly partner? It takes several forms, but the most immediate and beneficial with the universities is talent. To become a preferred place for the best and brightest to want to be able to have an internship with us. And the caliber of students that we're seeing in these universities today is, night and day from where it was 40 years ago when I went, I can tell you. And but it's working with the faculty and the leadership to build the brand awareness of what we're doing, and the fact that we are looking for the best and brightest, and having them kind of be recruiters, if you will, themselves to know, hey, for some of my superstars that I kind of really want to help as a professor, I have one I want to recommend to the PSF. Now, there are going to be research and investment opportunities with the universities, particularly, building facilities that we could be owners of that have long-term, 100-year leases with these AAA partners that we can be a capital provider for them in a way that's very attractive to our liabilities. And an area that I'm just starting the conversations on, I've mentioned venture capital as an area we had struggled with historically. And venture capital is all about access. That historically the best venture firms they would have to close their funds. They had capacity limits. If you weren't a GP in the first one, you just weren't even invited anymore. And some of the best performance in venture today, is in AI, right? And but those funds are just inaccessible. But our major universities in the state generate all kinds of interesting research, a lot of which is patentable IP. It could be in technology, it can be in pharma, it can be in a variety of things. And in early discussions in being on the front end of helping fund some of the more promising strategies with some venture partners to allow us to be, why should the things that are being generated out of Texas universities end up being a star in a New York VC's fund? why shouldn't it be here? With corporations, it's pretty obvious, we've said this many times, we're, the seventh, eighth, or ninth largest economy in the world. So, it stands to reason there's going to be a lot of business opportunities in this state. So we are twofold, investing with management teams that are Texans and headquartered here and work here, but also teams in Texas and outside of Texas that are deploying money into companies in Texas. So that's the three kind of layers of that and indeed, as I said, out of a $60 billion fund, without the slightest compromise in our underwriting standards, we've placed $30 billion with firms that either are headquartered here or have a significant economic presence here. And the feedback loop, it also helps in hiring. It helps with deal flow. It helps with ideas. It builds the brand that the PSF is doing things. And with that awareness, the best and brightest corporations and CEOs and universities have us on the radar screen, and we're starting to see more ideas and deal flow. So that's broadly speaking what that vision is.
Thank you. And I'll just say I've got a friend who's involved. There's a trading internship program at A&M. I think they're mainly focused on energy trading. I'd love to refer you to that program. They're some of the best and brightest Aggies. I think you got a lot of UT represented, but
I know we're in a public meeting here, but we have two, let's say, constituents, former stakeholders of this enterprise. One that leads Texas A&M now, and one that leads Texas Tech.
Right.
I am taking advantage of that affinity that they have for us to really ramp up this engagement with both of them. Because that's kind of a, you had me at hello thing, and we want to come and just show all our wares and say, we're ready to partner. Let's go.
Chair, can I ask another?
One more.
One more. All right.
Make it a good one.
Clark, I think you'll like this, Jared. The rating agencies, Jared, you're sitting there. I think this is the school bond backing program. I know it took an act of Congress. At one point, we were up against a cap. Are we up against a cap with the rating agencies that if we write too many more of these, they're going to lower the rating? Is that the discussion you're having? And or how much headroom do we have for more underwriting?
Yeah, that was the trade-off, right? So with the implementation of our new risk systems, we're able to model future cash flows and future debt issuance. And that relationship is the debt issuance with growing mid-teens and the corpus was not, right? And so what ends up happening is that capacity was going to get constrained. So we engaged all the rating agencies, reviewed their methodologies, ran it against our own internal models, but then really worked on an advocacy campaign to make sure that they understood the way that we saw the world. They understood our portfolio the way that we saw it. We showed them how we would access liquidity, what were the ways that we would rebalance, and what would be the opportunities for us to make sure that we maintain sufficient liquidity in a stressed environment. And they actually were very appreciative of us kind of collaborating with them. And in fact, 2 out of the 3 actually enhanced their methodologies. So the information we gave them, they were able to actually incorporate, which increased their liquidity scores for us, which increased the capacity. So effectively, we've pushed out any kind of capacity concerns out into the future. Now, I'm going to say we're not done. This is an ongoing engagement. We're going to do this with the ratings agencies forever. So we will continuously do this, but it was certainly last 6 months, every single day working with them to make sure that we were not going to jeopardize the AAA credit rating.
So I guess my kid's school district bond is safe for
Yes.
now,
Yes.
and we've got some room to
Yes.
for the next few years. Okay, great, thank you.
I might add a little color to that too. The engagement led us to be able to provide a lot more information than these rating agencies historically had. So that just underscores the fact that historically the PSF was more of a passive receiver, whatever came down from the rating agencies, and we've become a proactive provider of information that helps them do their job better. And that's why the dam broke, because we were giving them things that they heretofore didn't have and that they found useful and were happy to put in their rubric. And that has really opened up this process in this discipline.
And the thing that's a little tricky about that is that even though that we're guaranteeing those bonds, the administration of that still remains over at Texas Education Agency. And that's why that we've also, opened up a line of communication on that. We thought we were gonna have we literally thought that we were maybe in a looking for all alternatives to this and how we would fix that. But I think that we were able to make enough headway with the rating agency where we didn't have to do that, but we still have those things in our back pockets.
One of them who I will remain nameless right now, that's draft form, but I will share with the members, has taken an unprecedented step of doing a mid-year re-release about us to tell the bondholders that we are taking a broader, multifaceted approach to now viewing the creditworthiness, and they're passing that out in a formalized memo to the public.
Yeah, I had a question.
Sure.
And I'll try to be disciplined like you want us to, but I may have to ask as we go.
Sure.
One or two, because I'm forgetting some of the ones I want to. Just educate me. Everybody around the table probably understands this better than me. Our target is 7%.
It's not a target per se. What we have is an expected return. We look at all of the asset classes that we own, and the NEPC we'll talk about here in a minute, the discipline process of really ongoing. There's like quarterly updates, but every year there's an exercise to look at all these asset classes and try to make a best efforts, scientifically based expectation of the next full market cycle, 7 to 10 year outlook. What can we reasonably think this asset class is likely to generate? And even if you don't change your asset allocation, we're re-underwriting those expectations. So the example I gave, when you have one that has for several years running performed a lot higher than its long-term average, it stands to reason you're going to want to dampen your enthusiasm for those returns going forward. Once we've established each of those returns, when we then do a weighted average times, the individual weights that we are invested in each asset class by each asset class's expected return, we come up with the portfolio's expected return. The only thing we really use that for is it anchors our distribution rate. To come up with a sustainable distribution rate, you start with, well, what is the portfolio likely expected to generate? I will point out, we do not include in those returns any alpha, any excess returns that we are hoping that our managers can generate. It's good discipline and conservative fiduciary practice not to bet on the excess returns. We hope to get, but we're just modeling the asset class itself. So it's not a target. There's an expected return. And
Expected return for distribution.
Yes.
I got it. I was confused. Okay. The other question, and I don't, like I said, you went through this, you said you were doing some leverage protocol. Explain a little bit more.
Yes. So leverage exists throughout the capital markets. Even people, I think don't always think about when they buy stock in a company. You're buying a levered equity position. Most of these companies have 6-8 times debt equity ratio. And so you've got leverage as soon as you buy a stock. We have what can be considered leverage in long-short strategies, because when you short a stock, you actually are getting proceeds back and then you're redeploying it in another stock, and you actually have doubled your exposure. On the other end of the spectrum would be considered just outright borrowing against our whole portfolio, to say we're going to use our collateral and we are going to borrow some money. That could become very useful in times of crisis. In the middle of this, you can lend individual securities, and you can both stocks and bonds in the repo markets overnight. You still own it. You still have the benefits of owning it, but you let someone borrow it for settlement and they give you some proceeds here. So there's many facets of leverage. I noticed in our review of our policy, we didn't have a leverage. And we looked at what our peers done. Permit University Fund is 10% leverage limit. That's what we use. Teachers last year, some of you may recall, increased their leverage limit to 20%. So my thinking, Member Thomas, was this. There is leverage in the system, and we don't have any limit expressed in the policy. It seems to be good fiduciary practice to put a limit out there. And we started with the limit and the language that our sister fund, the permanent school fund, uses. But once you put any limit in a policy, you have to figure out how you measure compliance to that policy. And that's what we've got to work on, because it's not a simple calculation. And there are certain things, I think, that what we'll end up doing is saying, you know, apply to that 10% leverage, and some that don't. And we have to go through that process. And it'll take us 2 or 3 quarters of discussion to get it refined.
And add something. The key on the leverage is not so much defining leverage. There's multiple ways you could define leverage, borrowing, notional. It's to move to the next step of what is our risk exposure, right? And you can take an enormous amount of risk in a long only single stock that is highly volatile. You could have a position that is seemingly levered that has much less risk. I mean, a simple example, if I own a basket of stocks and I hedge them, under most conditions, that hedge portfolio is going to be less risky than the unhedged portfolio, and yet the leverage on a notional basis is twice as high. So as we engage the board, provide transparency and talk about our portfolio, we will have a lot of discussions about both what we mean by leverage, but more importantly, what is our overall risk profile? And this goes to the question you would ask on how are we planning for dislocation and how we take advantage of that. It goes back to the level of risk, our resources. So it's reasonably complex, and we will start tackling those things as we have more risk discussions.
So go ahead. There's something else I wanted to add to the importance of this. We're looking at, you know, having lines of credit on hand, you know, so there'll be a dislocation, and, you know, we want cash in the worst time. And, you know, they're rather complex to establish, you know, a lot of legal work behind them. And, you know, you've got origination fees and terms you have to live with. There's other less expensive and quicker to implement forms of borrowing we can use before we get to those. But here's the important point I wanted to make. The rating agencies view leverage and lines of credits as a positive, because it shows that you are able to borrow money. You have the mechanisms. Not only are you creditworthy, but are you operationally able to do this? Because they want to know that if we are in, you know, DevCon 5, you know, crisis mode, that we will always be able to pay the debt service on a bond. And they see that, they look at that as a positive. So you know, it's part of a risk, right? Our job is not to avoid risk. Our job is to manage risk. Our job is to take on risks that are well compensated. What we want to avoid are poorly compensated or uncompensated risk. And leverage can be both a risk reducer or a risk amplifier. And we will use it in both cases for different purposes. And I liken it to derivatives. They used to say, you know, derivatives are bad and leverage is bad. It's like saying electricity is bad. You know, electricity lights our homes, you know, warms us, cooks our meals. But if you stick your finger in the socket, you'll get electrocuted. So it's just how you use it and how you manage it and how you oversee it. And because it is nuanced and because it is in several different places in the portfolio, this will warrant regular discussion and education and understanding, so we can figure out what it all totals up to and means.
May I add one more thing? Bob and I could sit and talk about this for a week. It's what we love and what we do for a living. But one other concept I'll add that I think is very appropriate for the board and for the many people who listen and think about what we do, this notion of we try to drive a hard bargain with the risk we take and get good returns. Many people define risk as the probability of losing money, and most of us think about it that way. You know, something happened and you lost money. But I would submit that you should also ponder that risk is a probability that you don't meet your goal, you don't get your expected return, you don't meet your objectives. So, for example, just as a hypothetical, let's imagine the entire permanent school fund was invested in overnight rates at 4%. Is that high risk or not? We may say no, because we're not going to lose money. I would argue that's extraordinarily high risk. Why? Because we're unlikely to get the inflation returns. So over time, we're going to have less money for future school children. We're unlikely to have extra money for growth in the school system. And we're unlikely to have real returns. In fact, we absolutely will not have real returns. And what would that mean? No distributions. So if we were sitting here with the T-bill portfolio right now, we would basically have assured our failure on our key objective, and that is fund the school children in Texas. So when we think about risk, it's not just probability of losing money. It is probability of meeting our objectives, which are real returns that allow us to fund school children today and school children tomorrow. And that sets the stage for a discussion of what kind of risk we take and how we manage.
Gordon?
Any other?
No, I'm delighted it created such a conversation.
It's good.
Yeah.
Mr. Chairman.
Yes.
Yeah, so our fund is different, right, than teachers, because you get, pick your year, billions of dollars of cash infusion from the oil and gas revenue. So when we look at returns, I mean, we're not an isolated fund that just got returns off the revenue we generated. We get this external input of money. So it's so hard for me to look at what percentage we make.
Okay, so
understand how that affects
that's, we need to clarify how performance reporting works and how performance calculations work. And the short story of that is contributions are not returns. They are not part of that
Yeah,
calculation.
but they raise the value.
They raise
So
the
when you
value of
raise
the
the
fund.
value a couple $2 billion, your returns are gonna look pretty darn good regardless of what you do, right?
Yeah, it's not going to change the percentage returns. It's the asset base that grows. And in the case of gifting, like I said, even if we reduce our expected rate of return, the reason we're doing it is because markets have run hotter than we thought they would over the last 5-6 years. You have banked that. Your asset base has grown. So you might have a smaller expected rate of return, but you're applying it to a bigger base, and that equals a larger dollar amount of distribution. But I want to make it very clear in performance reporting, just a contribution and a withdrawal do not fall into the performance calculation. When we say we made 7.1%, it's not affected by that. By the same token, when we make distributions, those aren't losses coming out either. It's accounted for differently. So anytime we are talking about returns on the portfolio, it is not affected by contributions or withdrawals to the plan.
Since you brought up distribution, I'll just say it again, because we'll have the allotment for the available school fund come in, and I know right now oil and gas is great, and hopefully it's going to be great for another 100 years, but you know, the contribution to the available school fund from the general land office was our 16 trailing quarters of our assets, the $9 billion which transferred to this fund. So at some point, there's going to be where oil and gas doesn't generate that revenue, and y'all are going to have to know that allotment is really coming from the $9 billion that transferred a couple years ago.
Yeah, we are starting to, I'll let colleague add to this, but one of the things we've done from a risk standpoint is we look at all of the assets that benefit the permanent school fund, including the royalty program, which we know is highly correlated to crude oil and gas prices. And I was having a discussion with the colleagues at Permanent School Fund, which is very similar. They have the University Lands Office and they have the Permanent University Fund. And looking back at, how volatile that can be like coming out of COVID, when oil and gas prices dipped into the 20s, something, all of a sudden, those contributions just fell 75, 80%. And we know that, and we're modeling it, and it always, works against you when you don't want to have it. In a time of crisis, when we want to be able to raise cash to take opportunities, all kinds of things dry up, and we know that's definitely going to be one of them. And we're modeling it that way. We also are looking at, the valuation of that pool, that group of royalties. I think rightfully so, the GLO has employed a conservative valuation mindset over the years. When the third parties are looking at all the different wellheads and streams, and everything, they've got a variety of scenarios. But the top line number that's published is a conservative number. From a risk standpoint, we actually want to look at the more optimistic, bigger number because it just magnifies the risk that's actually there. So it's under promise.
The only other thing I was going to add, Commissioner, you're exactly correct. So one of the things we've done is we've built a model to try to forecast oil and gas contributions. But we've also done a lot of sensitivity analysis, and we do incorporate that into our overall distribution to make sure that we can still pay the 5A and 5G. So there is a point where it could get uncomfortable, right? So
I just don't want to wait till that point.
Yes.
To remind everybody in the room, since we have new
Yes.
people, that, you've got billions of dollars that allotment should be coming from.
And so
not
we've-
just the oil and gas revenue.
and we know at what point that becomes uncomfortable. And we've got reasonable forecasts to find out what is the likelihood of that happening, and it is absolutely a risk. So I appreciate you bringing it up.
Then it's kind of one of those things is that, you've got two different distributions. And, people just think that they're $2 amounts, but how they're accounted for is somewhat different, and that's, with the 5A versus the State Board of Education does versus the 5G, which this board does, but that's a lot more tied to exactly what you're talking about. Yeah. And so, yeah.
I think we're a long way from that. I just like to
Yeah.
say it.
Sure. Folks online, do y'all have any questions before we move on? All right. We're going to keep moving. So we are, we've been blessed for the past 17 years to have the services of NEPC. Starting with us, I guess it was 2009. And Red Humphreys has with us, I guess, since the beginning. Is that correct? That is correct. And was a great partner, and done a lot of work, and I think we've probably got our money's worth out of NEPC a little bit more lately. I think we squeezed up.
That money's worth is called a pound of flesh.
Yeah, just like it. But before we worked, my money's worth, and so it's not all I have for Japanese. By the way, Red's son attends Ole Miss, and of course that's kind of interesting. Red graduated from LSU, and LSU stole Ole Miss's football coach, and so I'm sure there's some discussion over Christmas about that. So, but we're also very very honored to have Tim McCusker, who is the CEO, the new CEO of NEPC. Has been with NEPC for about 20 years, and previously was the chief investment officer there, and is a Colgate Raider. Right. And so a lot of football talk. That's a good basketball team. Yes, and so. With that, as to kind of cue that up, and Tim, welcome to Texas, and Boston to Austin, and go ahead and cue up the NEPC to give their presentation.
Mr. Chairman, may I add a couple words?
Yes.
I'm thrilled that Tim McCusker has now been promoted to president of NEPC. I've known Tim from the day he started there. And he's a mathematician, he's an actuary, he's a CFA, he's a Kaya. He started and worked his way up through research and asset allocation modeling and performance reporting to be the CIO and now the president. I think this is a big uptick for NEPC, having what I consider a technician running a firm like this. believe it will have nothing but, a positive effect on the accuracy and integrity of their research going forward. And I'm thrilled to have them here. So Tim, and maybe somewhere in your commentary, maybe you can work in from your words, just clarify, because this question has come up many times, that performance calculation as it refers to contribution controls.
And words and introduction. Thanks for having me today. Thank you for the longstanding relationship. It's really impressive to see the transformation that's taking place. And then selfishly nice to get away from Boston. We can jump ahead. I'll try to fly through this. I just thought we'd go through the NPC overall outlook in one slide, and then just give you some anecdotes of things we see going on in the market. So if we flip ahead, we'll talk about the concentration in markets right now and what that means for markets, what that means for the economy. There are some elements of what's happened with dollars chasing the AI investment theme and the run up in prices that we've seen that would conjure up memories of classic bubbles. There's lots of elements that we see where it's not particularly bubble-like, and not many of the checkpoints overall would indicate that we're in a bubble right now. There's a lot less conversation right now and concern in markets about inflation risk, and we do think that is a long-term outlier risk for all investors, particularly for spending-based organizations like endowments, like the permanent group, aware of that risk and building that into the portfolio. And then frankly, the third comment, I think Fed uncertainty is a lot lower from when we wrote this at the beginning of the quarter. We have some certainty of at least who is nominated and likely to get the chairmanship. The Fed is clearly on pause now, and also from a political standpoint, the court has shot down the initial pass at trying to fire one of the board members. So the path forward for the Fed is pause until the new chair is in place, and they've left some room for some initial rate cuts to appease the administration and move forward from there, but less uncertain than what we were looking at. And then we'll talk about concentration. There's a lot of good things that come from the concentration in markets. There's definitely a wealth effect that powers the economy, but that powering of the economy has been very concentrated. It's been with the high-end consumer, and it's been in the areas that have benefited from this AI infrastructure build out that we've seen. So if we flip ahead aside, we can look at the concentration that we've seen. You can't talk about markets without mentioning the Magnificent Seven. This is the concentration that they have in the S&P 500. It's over 35% of the total index right now. Bob showed you some trailing performance numbers. I think that S&P 500 number for the last 3 years was 23-ish%. 2/3 of that has come from just these 7 names. Price run up like that, you see this kind of concentration. This is where I think there is some concern about bubble-like activity. But if we flip ahead one slide, you see that, and this is not quite apples to apples, this is the top 10 names versus the Magnificent Seven, but I think directionally still very accurate. The price increases are largely justified. These are incredibly successful companies. Profit margins are at all-time highs. They are spending, the CapEx dollars that they're spending are off of record profit levels. They are starting to issue some debt, which is a little bit of a concern, something we have to watch out for. But their PEs are not in the 90s and hundreds type range that we saw for companies like Cisco and Sun Microsystems in the late 90s. They are in the high 20s, low 30s. Those could be, in retrospect, very well justified price to earnings ratios for companies that are growing at the levels these companies are. Flip ahead a slide and we can look at how this is impacting the economy. We cannot keep up with this chart here. This is AI CapEx spending historically for the last 5+ years, and then looking forward projected for 2026. You can see when we printed it, it was over 500 billion. This is already close to 100 billion higher, 600, 50 billion, and likely marching higher throughout the year. So all of these companies, the leaders of these hyperscaler companies, when they assess the risks for their businesses, they view it as a much bigger risk to not invest than to just invest and keep up with everyone else. If they get left behind on this AI build out and they don't have the infrastructure, they don't have the computing power, then they could miss a technology turn and be the Netscape or the Yahoo of this generation instead of the Microsoft or the companies that keep winning. And that's the way that they are positioning this right now. What does that mean for the economy? If we flip ahead one page, you can see this is AI spending. So AI construction spending for all non-residential construction, all office, commercial, industrial construction in the US, over 40% of that in the last year now is dedicated to AI-focused investments, power-related investments, data center build-outs. It's almost half, and you just think of the knock-on effects of that. The areas where lots of data centers are being built, the types of industries that benefit, electricians, construction workers, chip manufacturers like NVIDIA. So there's a concentrated set of winners from an employment perspective, from an investment perspective that are really winning. It's really holding up economic growth in the US, driving it forward. There's probably 100 to 200 basis points of additional growth coming from this, but it's not cascading through the whole economy. It's hitting a very small group of winners, and that's something.
Tim, I think basically it's a tale of two economies, right?
Exactly.
The AI economy and all the rest. I read an article looking at the total capital investment, including other companies, not on your list of that top 10. I think the number was almost 900 billion. And I've seen more and more just crowding out effect because there's a fixed amount of capital to be able to deploy in the economy. And AI is eating up so much of it that other traditional industries are being capital starved. Anecdotally, where I came from up in Northern Virginia is kind of the data center capital of America. And they can't find electricians for building new homes, apartments, or schools because every available electrician is building a data center. And so it's both a fantastic, growth potential for what AI can do, but it is kind of constricting a lot of the rest of the economy.
It is, and it hits employment as well. If you're a young recent college graduate trying to get a job in professional services right now, it is really, really hard because professional services firms, finance, consulting, they're figuring out ways to use AI in the same way that they would historically have used analysts. That's a real long-term challenge.
That's our we.
Yeah, right. If we go ahead, we'll pivot and talk about private credit, which is a popular topic. Again, another area where there's a lot of conversation about is private credit in a bubble, just like the AI tech companies. You can see here that we are seeing an uptick in credit events in the direct lending space, sort of the core of the private credit asset class. And that's not surprising. That's happening in public credit as well. I think the important thing to remember with private credit is that, very simply and obvious, it's credit. It is not a panacea where you're just going to get double-digit returns without any risk. It's easy to conclude that because the last decade plus, that's what's happened. It's been there hasn't been that economic event to drive things downward. And we have started to see some credit events happen. If we flip ahead here, I'm not going to go through this chart in detail, but one of the big stories in private credit in 2025 was a company called First Brands. First Brands is an auto parts manufacturer. It's a roll-up of a few different companies. Took out a ton of debt on balance sheet, off balance sheet, using receivables to back some of that debt. There's some fraud involved there. But I think when you look at the details here and think, what does that single credit event do? This was owned across the entire credit world. There's lots of major private credit names that you'd recognize here. And it's sort of been identified as a private credit story. But there's public credit names here too. There's Wamco, there's PIMCO, there's Wellington, big brand name investment managers that held this paper as well. But one is that it's not just private credit. Two, very different from the way private credit used to be held before it became an institutional asset class, where 20 years ago, this would have been held by a consortium of 3 to 6 banks, and they would have taken $1 billion hit each because of this event. Instead, it's diffused across the entire industry. And so that single credit event doesn't cause the contagion that we would have seen historically. A little bit of a comfort message there on private credit.
How many were there?
There's, I think, over 50 different owners of it. And there's different structures within it. So there are different like cohorts of debt tranches. An event of $6+ billion. Turning to economic growth, I'll give the good news first here. The one big beautiful bill was signed into law in 2025. It did not have much economic impact in 2025. It was pretty neutral, but it is front loaded for these next few years. So the deficit spending that's coming from this hits in 26, 27, 28. That is bad for the long term. It's more debt that gets taken on for the US economy. It's good in the near term for economic growth. It is more spending in the system that should drive further economic growth. So this is stimulative in the same way that Fed rate cuts are stimulative. This is positive for the US economy. But if we flip ahead, I'll quickly go through these next 2 pages, we see a deficit picture that is really troubling for the US. The CBO, the Congressional Budget Office, just released new numbers this past week. So this is not updated, but it's a very similar picture of 5, 6, 7% federal deficits over the next 10+ years. That means if we flip ahead 1 page, we're issuing more debt to cover that. If we were just growing GDP, if we can grow GDP at 6, 7% to match that, debt to GDP wouldn't grow. We'd have to issue more debt, but the economy would be keeping up with it. You see here a number that's going from 120 to 130+% debt to GDP. This will, to Bob's comment of crowding out with AI, this will crowd out federal spending. If you have to issue more and more debt, and this is not even accounting for rates getting higher, but if rates just stay where they are, more and more of the budget has to go to covering your interest costs and not to the things that will drive economic growth.
Tim, I think it's worth making sure everyone looks at the scale at the bottom, because this is going back, to the 1930s. And not since the arsenal of democracy in World War II did we ever have to finance something that big, and we are now exceeding that level. So, and from a historic perspective, it is a red flag.
It is. And from a global perspective, if we go to the next page, there's the red flag.
Well done.
Not only historically, but if we flip ahead 1 page, globally, I think, I remember coming out of the financial crisis, there was a lot of talk of the United States being the cleanest dirty shirt, that the economic picture wasn't great, but it was better than Europe, it was better than emerging markets, better than Japan. And you look at this now, 15+ years later, on the vertical axis is that deficit number. So we are running at a 7% deficit for 2025. And then on the horizontal axis is that debt to GDP ratio. So how high is your debt relative to the total size of your economy? And now you see the only country with a higher deficit is Brazil. And the only 2 countries with higher debt to GDP ratios are Italy and Japan. So the US has really let their fiscal and debt picture erode over the last 15 years. And I think that's why you see on page 14, central banks around the world buying more gold. It's why you see gold doubling, tripling in price over the last 5 years, jumping up $5,000 an ounce, because there are long-term concerns about the dollar as the reserve currency of the world. Now, I don't think that's changing tomorrow. I don't think the world is abandoning dollars. There's not a great alternative out there, but there is this shift underway where it's not as reliable of a long-term asset and store of wealth as it had been. So I'll wrap it up. We'll go ahead one page and just hit some of the big themes here. AI is a powerful theme. Everything that we looked at the concentration, there is a chance, a non-zero probability, we could debate what that probability is, that AI is such a transformative technology that it drives economic productivity, drives GDP growth to a level where those deficit and debt issues for the US and the rest of the world get solved by 5% real economic growth over a decade. I think that long-term and that high of a level is probably not realistic, but it could be so transformative, more transformative than the internet, where it does solve a lot of these issues that we have. But as a base case, there's some real concerns here. We have a very concentrated market. As Bob mentioned, you've sort of grabbed a lot of future returns already, and they already sit in your investment portfolio. And future-looking returns are likely to be more muted. We are not going to get the valuation pop that we got over the last 40 years of price interest rates fall. You're going to have this issue of debt and deficit loads causing a crowding out, where not only are you not able to spend on the things that matter, you may get more inflation because rates are rising and there's just more issuance of dollars to cover everything. And from a portfolio perspective, and I know you'll get into it more, the Permanent School Fund has taken actions to try to manage through some of these challenges and opportunities that we see at balancing out the equity portfolio, making sure you've got enough exposure in areas like private credit and broader illiquids, where we see more opportunity over the long term. And then I think to the bigger point, you've got a healthy dynamic outside of investments where you have dollars coming in. That is, I think that frames the risk picture for the investment team, that with contributions coming in, you can take a more risk balanced approach, as opposed to a pension where you might have negative net cash flow and you've got to earn so much that that net negative means investment returns have to do all the work. The contributions don't impact your return. That return is a percentage of your total portfolio weighted for when the dollars come in, but it does impact how much risk you need to take.
Questions? Yes, sir. Mr. Hickman.
Yeah, just sure I'm on the right page. The AI spending, it's your slide 7 or slide 32. A couple of questions. Is there a little dip in that when it's going down to the 42.4?
Yes, in the last year, it peaked over 40, it was about 43.5 and dipped to 42.4. I don't think there was actually less dollars spent on AI. I think there was more spent on construction outside of AI. So as a ratio, it fell, but total dollars spent were still growing.
And are the people profiting from all this spending, the companies providing the AI data centers, the services, or regular companies able to now profit? Is that a answerable question?
On the data center build out, the profits have been more with the constructors of the data centers and the owners of the land and the energy companies providing the power. The long-term unknown is how profitable will this be for the companies supporting that spending by leasing out the data centers, using the chips. Will they see the ROI for all that they're spending? That's definitely an unknown.
Thank you. And my other one is on your page 12 or page 37. It's the government debt GDP just continues ramping up. I remember Greece a few years back had austerity measures, and then you've got the other chart where you were comparing Italy, Japan, Brazil.
Yeah.
And how close are we to that? When do we run out of, how much higher can this go?
I think it can go, I think it can go quite a bit higher and it will take a crisis really to solve it, because there's not a lot of Washington politicians that look to cut spending and stay elected. So it will take market pressure, which we have seen. We saw it in the UK just a couple years ago. Remember Liz Truss issued a budget thing, and UK rates accelerated almost 100 basis points in about 48 hours, and they had to back off of that. We haven't. The US, there's a certain view of the dollar still, even with these challenges, that the US has the spending power, has the reserve currency that they can continue to spend at these levels. But it will be a market reckoning type of event. It will be the market bond vigilantes essentially saying rates have to rise to cover this, and that's what will cause decrease.
Thank you.
That's what you're talking, inflation.
Yeah, that's right.
Folks online, any questions? We just, we can see you up on the screen. We just don't want to forget you here because you're not sitting here around the table. Okay. With that, if there are no further questions, Tim, thank you for, thanks for coming, and
Thank you.
come back, and we'll, take out some barbecue or something like that.
Sounds great.
Yeah.
Sounds like
Go to Boston, have some chow.
sounds good.
Yeah, so, okay, our next item of business, everybody okay, or do we need to take a break? Will we be good to keep moving? Okay. We're gonna move on to, item number 4, discussion and action related to the investment policy statement. So this actually is there's 2 pieces to this thing, okay? And so one is the actual policy the investment policy statement, and the other one is the asset allocation.
Thank you.
Which lives inside as an appendix to the investment policy statement. However, the asset allocation is one of the fundamental things that this board does. And so I want to take those things up separately, and I'm going to start with the asset allocation. And we're going to take that up first, and then we're going to move on to the text of the policy, okay? And so with that, I'm going to go ahead and I'm going to call on Jared. Yes. And if you will take the ball and run.
No, we appreciate Tim kind of going through NAPC's views. We've got a great relationship with Rhett. We've worked with him for a long time. And so when we go through the asset allocation discussion, it really is collaborative with NAPC. So I appreciate the good work we do together. So on the next page, my objectives that I want to cover today are proposed new, but I think modest asset allocation changes. I also am going to recommend some benchmark alignments that will make the portfolio benchmarks more relevant and investable. Followed by, I want to describe, I think we've already talked about it enough, and so I'll probably briefly go through it, but talk about the engagement with the rating agencies and the impact it has on the AAA credit rating. And then finally, before we get to the end, we'll kind of have a summary overview of the investment policy statement. So on the next page, as Tim mentioned, what we broadly see is lower capital market expectations in the future, and specifically with lower equity returns. So as Bob mentioned in his report, the 3-year number is a 23% return for the S&P 500, right? And that's not what we were expecting 3 years ago. And so a lot of those returns have been pulled forward, which makes that the price that you're paying for those earnings historically high, which could suggest a period of mean reversion in the future. But as Tim talked about, as long as these companies are maintaining high profit margins and strong earnings growth, then they're priced appropriately, but they're subject to some shocks if that doesn't occur. The other good news for the distribution and the fund overall is that inflation estimates have been trending lower. So month over month, we're seeing decelerating inflation, which has also been historically from 2 years ago pushed market estimates for inflation lower. But we are still seeing some weakness in the labor markets and residential housing, which is going to put a cap on overall inflation. And then finally, as Tim mentioned, the Fed uncertainty. So there was uncertainty in the composition of the Fed that's been resolved, but it still remains that the path of future cuts is unclear. So even though we've had 3 cuts in the last 4 meetings, The 10-year yield is remaining relatively stable. So this is just a comparison of the returns and risk that we used back in 2024 when we did the asset allocation analysis and comparing them to where they are today. And these are NEPC's numbers, and we work with them, we pressure test them, we have our own model, we debate them. So we feel comfortable with the estimates. But I really want to draw your attention to those yellow columns on the right-hand side, the return difference and the volatility difference. So what you see from 2 years ago is that red number indicates a decrease in the return estimates. So I want to kind of start with cash, and if your eyes move down that column, you'll see most of those are red. So we are seeing lower return expectations almost across the board. In addition to, we're seeing some large increases in market volatility as it relates to specific asset classes. And so when we combine the old estimates with the new estimates, we can kind of compare and contrast for the total fund. And that's exactly what this next page does. So overall, we're recommending some modest changes to the asset allocation. So I'm gonna start at the very, very top row where it started with cash. So our current policy is 2%. We're recommending a 3% allocation. So that positive one green number is an increase. And I want to kind of just go down that difference row. So starting with cash, tips, core bonds, and non-core bonds. These are really small, modest changes within our overall public debt. So we're going to increase cash by 1, decrease tips by 2, decrease core bonds by 1. And the overall impact of that is it's about an overall 2% reduction in our public fixed income. So I think it's modest overall. We're just making some small tweaks within our public debt program. Below that, we'll move to public equities. So with US large cap, we're increasing by 1. US small and mid cap, we're decreasing by 3. And non-US developed equity, we're increasing by 1. Same idea, some modest changes within these sub-asset classes, but overall, our public equities are only going down by 1% overall. So a material change is the absolute return program, which is going to be an increase of 3%. That's been actually one of our best performing asset classes. And it's a defensive posture, so it will work well during dislocations. For private debt, a modest increase by 1.5. We're not making any recommended changes within the private equity overall weight, and then a small decrease in real estate, followed by a tweak between our real asset natural resources and real asset infrastructure, just a -1 +1, but those are offsetting and we're remaining at 10 overall. So the overall impact for the total return, though, is about a 70 basis point reduction in our forward expected returns and an increase in the overall risk by about 40 basis points. But again, that's largely driven by the changes in the capital market expectations from 2 years ago, not necessarily the portfolio changes that we're recommending.
Said something, when you look at this, you see it sort of quivering a little bit, minor adjustments. But I thought Mr. Thomas made a good point when he asked about what's the goal here. One, we put a lot of work into estimating future returns, but they're future returns. If all of us knew future returns would be on our 500-foot yachts right now, right? We don't know the future returns. No one would have said 23% a year over 3 years for the S&P. We put a lot of work in, we come up with our best estimates. And the reason we do that is we want a portfolio here that, if you get to Mr. Thomas' question, will beat inflation by 4 or 5%, because that's the number, the real return that we use to pay the school children. So our best work on guesstimating future returns leads to a diversified portfolio of liquid and illiquid that we are confident can produce returns that exceed inflation and allow us to make our payments to the school children. That is sort of the big picture of what's going on here. And within the individual numbers, none of these changes are big, but that is really what we're driving at as we quiver and try to make modest adjustments.
And so if we did nothing,
Yes.
if we left the asset allocation just exactly like it is today and did nothing,
The risk would be higher.
the risk would be higher,
Yes,
and the return would be
the same. So yeah, this is de-risking the portfolio.
you're just reducing risk and keep the expected returns. So. Right.
Your target is to beat inflation by 4 or 5%.
I think if we could have that outcome every year, that would allow us to make our distributions and
Did you show us a slide to see how we performed this inflation in the last 4 or 5 years?
So, we do evaluate how our expected returns relate to the overall distribution and inflation adjustments. So if you think about 2 years ago, we had about 7% expected return. We had about a 1% student population growth and a 2.5% inflation rate. So did we exceed over 3.5 and satisfy this 3.5% distribution? And the answer is yes. And we've actually evaluated that over the last 15 years to try to maintain the same corpus in real terms per student and the distribution in real terms per student. So we are achieving our overall goal and we are beating inflation.
Can you give us a slide on that
Absolutely, absolutely.
by year?
Yes,
I mean, or just an email?
yes, absolutely.
And Jared, I think following up on Chair Maynard's question, it's like small, mid cap, you're cutting from 6 to 3.
Yes.
Big, and I guess it's because the expected return is about the same, but the volatility is higher, so that's the de-risking
That's
example.
That's part of it, but if you look at that row, US small and mid cap, that return difference, it's actually going down 1.27%. So you're right. So that return has come down. And then don't go to the other slide, but the risk has gone up. And so to your point, it's a less efficient asset class, which is why we're pulling 3% back out of it.
Okay.
And we also think that by changing the composition of the mix between US large, US mid, and non-US actually makes the total public equity program more balanced. And we can find better investment implementation opportunities with this new asset class just within public equities.
Thank you.
Of course. So on the next slide, this is a summary, and one of the things that we do compare ourselves to is how are our peers doing, right? And how do our asset allocation mixes compare to our peers? And so on the left-hand side, this is the Bank of New York Mellon peer universe of endowments and foundations greater than $1 billion as of December. And what this shows is that within their universe, our peers in that data set have 22.1% in public equities. And then on the next column over, we're comparing our old allocation of 27%. And that difference rounded to the nearest decimal point. So our previous policy was 5% over our peer group. And when we make these new changes, our new overall allocation is going to be 26%. Our new overweight versus our peer group is going to go down to 4. And then that far right arrow means we're increasing our alignment towards our peer group. And so if you focus on that right-hand column, what you're finding broadly is that we're getting closer to our peers, even though these changes are slightly modest, that we're becoming more aligned with our peer group overall. So we're going to be very close on private investments, which is equity and debt. We're still going to be slightly overweight in real estate, but that's coming down some. We're going to continue to be slightly overweight in real assets with no changes. With public fixed income, we're going to go down by a little bit, which will put us closer to our peer group. But the big one that you notice is that we're going to be off by hedge funds. The one thing I would offer, though, is that we don't have a lot of insights into the composition of every single hedge fund, what their exposures are, the return streams they get. And so when you think about being our overweight to public equities, public fixed income, real estate, and real assets, we believe that's roughly right in our overall exposure, even though we're underweight hedge funds. So we are still going to have some differences in our asset allocation, but these changes broadly get us closer to our peer group.
Jared, can you reconcile? I saw an article in the Wall Street Journal. Princeton was cutting private equity, saying that I think S&P, and maybe it's to your point, Stu, they're chasing S&P 3-year returns. Can you talk about that?
Yeah, so I can go first if you have any other comments, but if you notice on the previous slide, we weren't changing or increasing our private equity exposures. We're still going to target the same amount. What we find versus large endowments like Princeton or Yale, they've got significantly more. And I'm trying to recall this article. Yale had 5 times more venture capital and twice as much buyout and growth than we did. So some of these other larger endowments have significantly larger allocations. And so we're slowing down the pace of trying to get more aligned.
In that second line, private investment, it's including both private credit and private equity. And we're trying to favor private credit because of its cash flow characteristics and its the velocity of cash. And we are not wanting to get to the level of private equity allocations that our peers did. I mean, we're, 30 years behind that trend.
Mhm.
And now you see that is,
Yeah.
it's problematic. They got a liquidity trap. They're having to be forced sellers, and we don't want to get there. The game is too late. I think in my mind, private equity is almost traditional private equity is almost in extra innings, if you will, where private credit is kind of fourth or fifth inning. And it just, the velocity of cash there provides more liquidity. In fact, the rating agencies that was another one of the breakthroughs that we had, because when it said private in front of it, they wanted to say not liquid. We said, well, but if you look at the underlying loans here that are current pay, quarterly floating rate, 2-3 year maturity, there's a bunch of velocity in there, and we can turn off the spigot and have that roll back to us. So they started now giving us credit for some of that liquidity. So that's where we're differentiating ourselves from our peers. And we obviously historically left a lot of money on the table, not being at full of our peers. But there is some small advantages of being late to the party where you can identify the things that have run the course and not chase.
Got it. Thank you.
Any other questions on the asset allocation? Rhett, did you have any observations or comments?
Well, a couple of things. And so when you look at this first, those that don't do this all the time, asset allocation, diversification, really in our world, I think Stu was saying this, is a tacit admission that we don't know what's going to happen because we knew. It's a complicated quantitative asset allocation stuff. When you look at these sort of, we would call sort of marginal changes here, it's really a reflection of two things. One, and Jared said this as much, is sort of risk management. You're taking some risk off the table. So that was part one. The other of these small changes, it's really a reflection of this being a mature fund. 2 years ago, you made some changes. You were going in the right direction over the last decade or so, trying to get there. 2 years ago, you made some material changes to asset allocation. So as we sit here today, these sort of subtle changes are really just a reflection that the asset allocation itself is mature and in sort of the right place. And really all we're talking about now is making some marginal changes to take a little bit of risk off the table and get you set.
Just to, I guess, a little bit of historical perspective, that we're not that far removed from the time when we were not even allowed to do alternatives. And so this diversification, compared to other funds, like the Harvards and the Princetons of the world, I mean, we were a little behind them to begin with, and Rhett, you were part of it.
That's right. I mean, you were. I mean, it's I guess double-edged sword, but a little sad to say. PSF as a system, as an organization, was a little late to the private equity party because I've got so many questions over the last 2, 3, 4 years on relative rankings that come up greatly, massively in the last couple of years. Prior to that, they were down, and the answer was always, well, you've got a much smaller private equity allocation and real estate allocation. So these were leading performing asset classes, and your peers have so much more. And you were getting there every other year. You would change it and improve it and increase it. But what you really needed to do is you needed to have done that back in the mid-90s when your CEO and I were working in Louisiana building out one, and his Louisiana portfolio, private equity portfolio, being written up in the institutional rags as one of the best ones in the country. That's when you needed to be in, and it wasn't 2008. You were 10 years too late to be able to build into those rankings. But it's a delight now to see that you built that out starting in 09, 010, and it's beginning to now bear some fruit. And you're starting to see that now in the rankings.
Where the opportunities may come. Remember, Hickman said, put a point of the articles that you read. Some of the large endowments have got this liquidity squeeze, and they have been selling in the secondary market some of their private assets. Fortunately for them, they are selling it during a time when we do have steady trending markets, and the discount that they have to sell it is not too onerous. But if we get a dislocation and a real crisis where we've got public equity markets drop 40, 50%, and interest rates go up, there's going to be some fire sales of those assets. If we can be in position to have liquidity, we can be the provider of that liquidity and take advantage of significant discounts on the value of those things. That's another reason to hold back. There may be opportunities there because they will have liabilities that they must pay. And they're going to have to raise it for themselves. We can be a provider of liquidity. Regularly large discounts.
You keep some powder dry for that scenario.
Yes, that's exactly what one of the elements of this risk reporting that we're planning to do is the ultimate proof of pudding. And this is what Member Tom was referring to back in the third quarter, like this emergency plan. Well, we know we have to pay the 5A distributions and the 5G distributions, so we cash there. But if we shock the whole portfolio and then we systematically go, where can we raise cash now in a shocked portfolio? And how much can we raise? And some of that is going to be, liquid fixed income assets but part of it is going to be accessing leverage in its variety of forms to conjure up cash at a time when the world is in a liquidity crisis.
Any further questions? Jared, these, the benchmarks is part of the asset allocation?
I believe so.
Okay. So if you just continue on, we'll
Yes.
wrap this up and we'll dispose of this and go on to the call.
So on the, maybe to get one more. So I just want to talk about, there will also be, we're recommending some modest changes in the benchmarks for these asset classes. And I just want to set the stage that the PSF structure is really a fund of funds. So as an asset owner, right, we could either go hire a manager who then hires other managers, which would be like a fund of funds or a gatekeeper. Or what we're doing internally is as staff, we are picking other funds that have underlying investments. But when you roll all this together, the composition of it is really a fund of fund structure. We invest in multiple funds, combine them together, and it resembles a fund of fund structure. On the next page, for those of you that recall, benchmarking is really an art and a science. And I just want to draw a comparison. For those of you that remember, I was on the internal equity team before we changed the implementation style. I used to replicate the S&P 500. So if you think about the S&P 500 as a benchmark, it would align with all of these GIPS standards, right? It's specified in advance, relevant, measurable, unambiguous, and it's very, very easily to replicate. Other benchmarks like fixed income, especially our private markets, it's really becomes more of an art where you do a best effort to try to get the best representation, the best relevant, and make it as investable as possible. And we really feel like proposing a fund of funds benchmark better fits with the GIPS standards because it makes the benchmark more relevant. It also makes it more investable. And I'll kind of give you an example. Within private equity, there are over 8,000 private equity funds. We could never invest in over 8,000 private equity funds. And so this fund of fund structure actually increases the investability, but it still is imperfect. That a lot of these benchmarks, the constituents are not clearly identified or priced. And so we hope over time, private market benchmarks get better. We hope over time they check more of the boxes. And this is something that we'll continue to monitor and recommend. But we do think that using a fund of funds for our private market benchmarks that represent a good fit better aligns with the GIPS standards. So what that means on the next page is that for the asset classes that are more relevant, we will recommend benchmark changes. In addition to our performance measurement will reflect our internal expenses, which would be equivalent to a fund of fund structure. And fund of fund structures are real pools of capital and therefore investable. And so across the board, we would have better relevance, better investability with two primary objectives. Infrastructure and non-core private debt. They are too small of a sample size and also aren't relevant. And so over time, as those benchmarks get better, we will come back and make recommendations to align them to this fund of fund structure, but we don't think right now it is a good time based on its relevance and investability. Some other small changes is our private equity program right now in its current form is really apples and oranges. And it's not replicable. which means that the benchmark subjects the portfolio to a floating allocation between buyout growth and venture. And given our size, it would be imprudent for us to chase these venture investments. And we would recommend segregating venture out of private equity. And that way you have an apples portfolio versus an apples benchmark, and an oranges portfolio versus an oranges benchmark. And where that really allows is the board to set more realistic allocation targets, get clear accountability, and get better fit for the benchmark. We're going to recommend 2 small changes to core private debt. So this is a relatively newer asset class for us and the industry. But what we find is that our current portfolio has a duration of 2.7. The current benchmark has a duration of 3.6. And we're recommending a proposed benchmark that would have a duration of 2.6, which would increase the relevance and get us more closely aligned with the GIPS standards by correcting this duration mismatch. On the next page, in addition to core private debt, if you recall that there was an illiquidity premium, the current illiquidity premium that we're adding on top of that is 1%. In 2024, when we made these recommendations, the current illiquidity premium was 72 basis points. And in 2025, it was 57 basis points, and we're expecting that to continue to compress. And so we're recommending a proposed illiquidity premium of 50 basis points. So this final slide, and I'll pause after this, but this is just a summary of these changes. And so if you notice, I'll kind of start on the left-hand side. We think a fund of funds benchmark better reflects the PSF structure. We would recommend changing that for natural resources. The current benchmark is the MSCI Global Natural Resources Fund Index. And the new benchmark would be the same, except it would be in a fund of funds structure. And so if you see, we're still using the same benchmark provider. And we got the private core debt, the change in duration and spread, and then finally separating our private equity composite into venture and buyout and growth.
Did you work with the team on closely? Reflections on that, or? I mean, this is all consistent with sort of good policy in terms of what Jared laid out earlier around why you do benchmarks and the constituent parts of a good index or benchmark. I mean, little things like you pull out the changing this from the 3 to 5 to the 1 to 5. And part of the reason is as simple as the duration mismatch that we had before versus what's now, which makes as they walk me through, it made all the sense in the world.
Questions?
Jared, I've got a couple. One is concentration risk. If I look at real estate, you've got 10.5%. I was just in Singapore. Could you buy the whole Marina Sands and take all of that 10.5% with one building, one piece of real estate? Are there any rules around that?
There are. So we'll pause before we get to the IPS, but there's 2 governing documents. The investment policy statement prevents us from being overly concentrated by asset class. So we have a target weight, we have a min and a max, and the board sets that parameter for how much we can get around that. Then within each asset class, we also have investment guidelines that we provide to the board that limit the amount of concentration by structure, underlying investment, manager. And so the guidelines delineate that by asset class and across the entire fund.
I talked to Lane. I think that's Bob provides those annually, and then we get a copy.
Yeah, they're in your archives in Diligent, and maybe you can just anecdotally say for a couple of them. I mean, I think they're like the 3 to 5% one holding kind of.
Yeah, so it's by asset class. So larger asset classes have a little more bandwidth than smaller asset classes. So it is by asset class, but the concentration limits are fairly modest, somewhere between 2 and 4%. Underlying co-investments are less than roughly 25 basis points. Underlying, yeah.
So to your point, any one asset can only make up like 2 to 3% of that portfolio, which is only a subset of our whole portfolio.
Okay, so you can't go 100% Tesla stock.
No, absolutely not.
Okay. Thank you for that. The other one is a quality test. In my job, I do oil and gas contracts. If you're a buyer, we test buyers by net worth and credit rating and, guarantees and who's providing your letter of credit from the bank, that sort of thing. Is there any corollary or parallels with investments? Is there some investments that if I showed up, you'd be like, that's not a good quality investment. That's not something we want to touch. So can you grade an investment? And is there a certain level of grade that PSF will invest in and or not?
So when I say grade, it's not necessarily just a specific numerical number, like a credit rating, for example, but the overall answer is still the same. So we do investment due diligence, and we cover the firm, the philosophy, the people, the performance, the process. We also do operational due diligence and evaluate how that manager's operations are in relation to everyone else, and they do also get graded. And so we have a pretty good assessment of both the investment risk and the operation risk by underlying investment. And I wanted to see if I could quickly find the number, but we took over 2,000 investment manager meetings last year. We met with over about 800 specific firms, and I think 2,300. And we do business with about 1 out of 20 a new manager. So we are highly selective in our due diligence process.
Okay, so even if Bernie Madoff snuck through the meeting, that you'd still have the concentration risk that would limit the exposure for any one investment that got through your process.
Absolutely.
Okay, great. Thank you, Chair.
Any questions on benchmark?
I've got one question.
Yes.
Me too.
Jared, could you just describe the general difference in a fund of funds index versus the regular index? And is that just because there's another layer of fees, or what is in that?
Yeah, so there is another layer of fees, which is why we are also going to be accounting for our layer of fees to make it apples to apples. The main thing is there's over 8,000 private equity funds, but there's a lot smaller number of fund of funds. And so that universe is more investable. It's generally broadly diversified. And when we've looked at the historical correlations, they are a really strong fit. And so what we find is that it is more investable and more relevant when we think about the overall structure. But you're absolutely right. It's fees and also composition.
But I guess what the current benchmark is an index. So you're just saying that the index is of like natural resources. It's an index of all of the funds. And then the fund of funds index is just a smaller number of funds within natural resources.
Yeah, so I'll say it exactly the way you said it, and hopefully this answers your question. But if the index represents 8,000 private equity funds, the index of a fund of funds represents several hundred fund of funds. So you're absolutely right. The composition, how they compile it is the same. And you're absolutely correct that it's just a summation of fund of funds that invest in private equity.
Okay, thanks.
It's a smaller universe.
Mr. Chairman.
Yes, Mr. Kinsey.
Yeah, on the same line of questioning that I remember Wright had, kind of replying to. I spent some time digging into this with the staff on the fund of funds piece, and the thing that I really like about this is I know many of us have gotten questions in the past about how the overhead from the fund gets allocated, and when you look at returns and you're comparing to the market, is that appropriate? I spent about an hour digging in with staff on the allocation of salaries and bonuses and everything down to how that's going to be evaluated on the benchmark. And I'm personally very comfortable with it. I also think it was understated potentially by staff that not many fund managers are going to probably sign up for this kind of thing, because it does force accountability for the cost structure of the fund. So I'm a big fan and commend the fund leadership for taking this approach. And I see it as us leading again in the greater public fund space.
Yeah. Anybody else?
One follow-up,
Yes.
Mr. Chairman. Member Hickman, just saw the data to your question exactly. Within that real estate allocation, we currently have 4,000 individual properties. So that gives you.
Yep.
That's how small.
Sands is a nice place though.
Yeah.
Is that the one with the boat on top?
Yeah, yeah.
Boat on-
Yeah.
And the trees, the, crazy rotations.
Did you need to do anything with the?
The bond guarantee, no, I think we've
we've
discussed that.
Okay.
Oh, we're gonna talk about that.
There is, I think part and parcel of this is the transition period.
Okay.
Um,
Okay, so on a few slides going forward.
Diligence 62.
Thank you, 62.
Bless
So
you.
when we talk about changing from our 2024 targets to 2026 targets, even though they were modest, if you think about, every 1% change is roughly $600 million. So in aggregate, it's a pretty sizable rebalance. And what we would ask is an opportunity to do that prudently between now and the first half of the year. And so we would request the board approve a period of transition through June to allow for prudent reallocation towards these SAA targets.
You're gonna bump cash from 2 to 3.
Correct.
That won't take long.
That won't take long.
Especially, I wouldn't
Yeah.
drag on that.
Correct.
That's actually built into the motion.
Yes.
Any other questions? Mr. Wright, do you have a motion for us?
I do. And I guess just to be clear, Chairman Maynard, we're at this time only option 2.
Yes.
Okay. I move that the board adopt the Texas Permanent School Fund Corporation asset allocation targets and benchmark changes as reflected in the revised Appendix 1 to the investment policy statement effective January 1, 2026, with a period of transition to conclude no later than June 30, 2026.
Okay. Motion in a second.
Second.
Second. We got a motion and a second. Okay. Any discussion on the main motion? Do you feel pretty comfortable with that?
Just so I'm clear, this is page 72 as proposed, but adding in the transition, I don't see that on page 72.
Yeah, it's, I think we would look back to the minutes for the motion. There is an asterisk. If you look where it says target allocation, there's a little star. And then there's a footnote there, right to the right of where it says total 100%. It says subject to board approved transition plan. So that this timing through June 30th is that transition plan.
Okay. Thank you.
No discussion? Is there any objection to the motion? Hearing no objection, motion carries. Board, thank you. That's a big step. All right, the next thing we're going to go to now, as part of this item, is now we're going to go to the investment policy statement.
So on this slide, this was a summary in the appendix. So we appreciate the approval on that. In 2 slides going forward, I'm just going to provide a broad overview of the recommended changes to the investment policy statement, excluding the appendix. And so what we would offer is that this new IPS would accomplish 4 things. It authorizes the new strategic asset allocation, which includes the benchmark changes in transition period that was just previously approved. It also streamlined this by incorporating the securities lending into the IPS. It also enhances board's oversight with the leverage guardrails, as Bob previously mentioned. And then within that, it provides some clarity with some non-substantial draftings and cleanups.
Okay. Lane, you've been managing the document, and first of all is that there's a lot of red line in this thing, and a lot of that is because a lot of that migrated to the governance.
That's correct, Mr. Chairman, and I am prepared to spend as much or as little time as we need to on this. Like we could flip pages, I could tell you which edits go into which of those categories that Jared just highlighted. If that makes sense, or,
It makes perfect sense.
okay, so, diligent page 65. I would put all of these changes in the category of cleanups, and non-substantive. Diligent page 66 is exactly what you just mentioned, Mr. Chairman. We adopted the board governance manual. The IPS, as it currently exists, lists roles and responsibilities for board, CEO, et cetera. All of that stuff is migrated now to the governance manual. So now the new language just references the governance manual. This is not a substantive change. On the next page, diligent 67, it says custodian. In the December meeting, we adopted the board governance manual. One of the provisions there was that the board will approve the selection of the custodian upon the CEO's recommendation. It used to be the case in the IPS that the CEO selected the custodian. Under strategic asset allocation, this is just a clarifying change that appropriate committee of the board will be involved in a formal asset allocation study. Next page, diligent page 68. Again, clarifying changes. The paragraph in the middle of the page that has red and blue, this is the period of transition that we just approved in the footnote to the appendix. So this is what that language does. The I guess first sort of substantive topic is here at the bottom of the page where you see securities lending. As we sit here, we have two policies. We have an IPS and we have securities lending policy. And the securities lending policy has a whole bunch of detail around the program. And so what we're proposing here is to streamline and clean up and to add here the authorization to do a securities lending program. We've also included a credit test for the securities lending agent of A- equivalent or better. And then we would take all of the details and the in the weeds things that exist in the current policy and move that into the investment guidelines that we were discussing with Mr. Hickman that have concentration limits and things like that, because it really is, it is those sorts of details. Next page, diligent page 69. This touches on Mr. Thomas's question from earlier and the discussion around that. The leverage limits. Bob described this previously as sort of a delegation upwards. We do have some leverage things in the investment guidelines currently, but we think it's more appropriate and better aligned with peers and best practices to put that here in the policy. So that's what that does. Best execution is just drafting cleanups.
Can you pause there and
Yes, of course.
explain what is the intent? Are you balancing best execution and lowest cost?
Yeah, so the policy and the practice is all things equal. You want to make the best execution of the trade at the lowest cost, but there could be exceptions to that. So for example, we have our strategic partner relationships, and there may be some instances where it makes sense to trade with one of them, even though it's not the cheapest trade, because of a holistic relationship, we get some sort of fee break somewhere else. So the intent here is to say, the policy is we always want the best price and the lowest commission, but there could be, if it's otherwise prudent, there could be certain exceptions to that. So we don't want to create a bright line footfall, but that is the policy and practice.
As I see, generally and if otherwise prudent, are those both pointing at the same? Generally, you want to be best execution and lowest cost, but there may be circumstances.
Correct.
where you-
That's exactly right.
Okay.
Spotted like a true lawyer.
You sure we're all on the same page?
Yes, sir. Next page is, there's a lot of red and blue ink here, but again, this is just, I view as cleanup. So the first thing we've done is just quoted the prudent investment standard from the Constitution under authorized investments and shareholder voting. And then we've added a sentence there at the end of the second paragraph that says, we vote in the fiduciary interest of the fund concerning like financial factors. We do not vote to advance social or political purposes. And then that's really it. We cleaned up where it said review and amendment of the policy to align with the governance manual. And then when you see the effective date there on the next page, that would be January 1st. And then it underscores the rescission and now incorporation here of the securities lending policy. And then just the next page is the red line Mr. Hickman mentioned earlier, this shows the changes that Jared, that the board just approved on Jared's presentation. And on the left-hand column, you'll see these highlighted numbers. We're going to reorder these in sort of a liquidity or risk order. We didn't do that in the red line because it would have looked like we just had torn it up and started over. But when you see a clean version on the website, these will be in the order as numbered.
Members.
Well, it's more, correct me, more liquidity and risk. So you start with cash and then you end with private infrastructure.
Yeah.
So, all right, members, questions? There is some, and by the way, this version of this is much streamlined. I think when we had it, we used to have it in rule text. It was pages upon pages. And we've pulled a lot of stuff out of it and we've streamlined it. And Lane, is this probably looks a little bit more like what they've got at utility?
I think that's right.
So, we've imported some talent from utility. Questions, concerns? Anything out there in there that jumps out at you, anything like that? So,
Bob or Stu, anything that's in here that, I mean, is this all aligned with what we just went through?
Yes, I believe so. And the real adjunct to Chairman Maynard's point was historically, this document was serving kind of as a de facto partial governance document. And the exercise we did last year to have our first ever standalone comprehensive governance policy is now superseded and left a lot of this, redundant. And so now it's a pure investment policy.
Yep.
And I think that's much more consistent with what our peers would have.
Brett, did you work with staff on this at all?
Of course, and I would say this page here is a formality of what you've just already voted for.
Yeah, we already took care of that. I'm not worried about that, but I'm just in terms of particularly, is there anything in there that concerns you at all? Not on that page.
So fair question. The only thing that concerns me, and we talked about this, Stu, myself, and Jared, is the idea of coming back to the board, making benchmark changes every couple of years. The optics of that can sometimes feel a little muddy, and so we talked about is we don't want to do that any more often than we have to. What's changed here is you made some material changes to asset allocation 2 years ago, and all this is sort of catching up. The other is in private debt. Private debt is still a relatively new asset class in the context of the broader markets. Benchmarking to that is still, and there's no other way to say it, in its infancy. So I would say managing expectations over the next 2 or 4 years, you would, as board members, you would expect some additional changes as those benchmarking universes sort of develop and grow out.
Okay. Mr. Wright, do you have a motion for us?
I do. I move that the board review and adopt the Texas Permanent School Fund Corporation Investment Policy Statement as may be amended effective January 1, 2026, with a period of transition to conclude no later than June 30, 2026.
Second.
Second.
All right, got a motion and a second. All right. Any discussion or any amendments?
Mr. Chairman,
Mr. Kinsey.
just real quick, I wanted to highlight that this came through my Committee of Strategic Planning and Policy Committee with Commissioner Buckingham and Perez Diaz. We spent significant time digging into this. Had some feedback for staff, had a collaborative work session, I would say, on fine tuning some things. And we felt comfortable at the end that we got to a good product. So just wanted to report that out, that we were highly involved in it.
If there's no further discussion, debate, or amendments, are you ready to vote? Okay. Any objection to the main motion?
Ongoing.
If there's no objection, motion carries. Congratulations. Okay, we've been going for 2 hours and 15 minutes. We have one item that the Stu has. We have a little piece that we need to take care of on committees. We're going to go to executive session to take up a personnel matter. And then we'll come back and finish committee reports and finish the meeting. But let's take a 15-minute break. It is 12:13, and so let's take a break. Get you a cup of coffee, get you a piece of banana bread or something like that out there.
And you made that?
I did last night.
Oh, that's so nice.
Yeah. So and we will reconvene at 12:30 sharp. So that's. Stu is gonna just give a rundown on the absolute return and public equity, and Stu will turn it over to you, man.
Thank you, and thanks to the miracle of AI and the 3,000 people who look at a summary of this call. I'm now going to get a lot of soup comments. So Chairman Maynard, thank you for that, and hate mail from Nebraska. But I'll do it. My second year anniversary, I do feel like I've been waiting for this job for a long time. It's an honor to be here. We're going to cover relatively quickly. We've talked about a lot of this today. There's a little bit of overlap. Our absolute return and equity programs. My objectives over the next 2 minutes are to define our investment approaches for both programs and explain how we choose our managers and why we manage hedge funds and equity programs together. Second, we'll briefly touch on the asset allocation changes. Jared covered those small changes that reflect the opportunity in the market force and also our commitments to remain highly liquid as part of our AAA rating. Third, I'll go with performance, which has been excellent. And lastly, I'll continue on the evolution of where we were, where we are now, and where we are going. I point out that a year ago, we had a pretty exhaustive discussion on these programs with Carlos Castros, who retired after a very long and successful career here. He built a tremendous foundation for equity and hedge funds. We miss Carlos, but he is enjoying retirement and left a terrific team, and you will see that in the numbers. High level executive summary for you, and I hope you will take away from this, is that our focus, our effort here is to identify managers who can outperform our benchmarks in a variety of markets. In particular, we like to find managers where we think they can do well when markets are rough, when we really need the performance. And we spend a lot of time on that. It's a risk-centric quantitative exercise that is focused on both the manager's portfolio construction and then our own portfolio construction, which managers we have, why we have them, when they're likely to do well, when they're likely to do poorly, and how that nets out to a performance that over a cycle is above our benchmarks with similar levels of benchmark risk. So that is the one takeaway. Second will be to discuss why we've increased allocations in our absolute return program. It is based on our peer groups, our very good performance. We know what we're doing in this space and a favorable environment for these strategies. Three, in public equity, we'll talk about performance, which has been good, reflects an intentional risk reduction. We're a little behind benchmark overall because we're running less risk, but the underlying manager performance has been strong. And lastly, I'll talk about the continuation of structural and economic improvements that have saved us money, increased performance by reducing fee layers and concentrating with top managers. I stepped into Carlos' spot as head of equities in ARS and deputy CIO. I mentioned 34 years getting ready for this. I've been a CIO, I've been head of risk management. I ran a $600 billion asset management business, and I worked at Harvard management when I was young, understanding what it means to manage risk and support an endowment style approach to investing. Terrific team members. Andre will pipe in here, pipe in anytime, particularly when I say something. And David and Pender. We have a good team and we're looking to grow this team at both junior levels and at senior levels. We expect to continue to allocate in the space. And as I touch on performance, you'll see why we are keen on this space. So objective one, why are we doing what we're doing? So in a nutshell, we leverage quantitative skills to identify, manage, and construct portfolios designed to deliver excess risk-adjusted returns with a bias towards alpha generation in tough markets. That doesn't mean we'll always get it, but that is our intent, and we design portfolios that we think over market cycles can add value, particularly when markets are in tough times. In the absolute return space, our hedge fund space, we have evolved to a portfolio that has low market sensitivity. So we refer to beta. Beta is the sensitivity to underlying broad market movement. So if you're exposed to credit beta, when credit tightens, you would expect to make money. If you're exposed to equity market beta, when markets go up, you'd expect to make money. We are trying to build a portfolio that can deliver returns with markets up or down. They're not highly correlated to broader markets. We have plenty of that kind of exposure elsewhere in our book. So the absolute return book is focused on strategies and multi-strat, equity long short, macro trading, credit long short, relative value trades, various areas where there is money to be made without picking direction. Importantly, we seek to outperform our benchmarks with similar levels of risk by 250 basis points. This demonstrates our skill. And we talked earlier about the importance of benchmarks for this board. You wonder, how do you know if we're doing a good job? And the answer is you have choices. You could hire fund of funds, you could index, or you can hire 80 people who work very hard here to deliver performance. The method for knowing whether we do a nice job is, can we beat those benchmarks? And you'll see the answer is yes. In the public equity space, we focus on increasing outperformance through multiple strategies. The first is index. We used to be entirely index. Index is tracking the market. S&P 500, buy 500 stocks in the appropriate weight. We still do some of that. We use enhanced index strategies or quantitative, where we use moderate active risk, primarily in tilts and small adjustments to try to beat the index. We've been successful in this, and we'll discuss that. And the third area is more active management. Higher active risk, think of it as fundamental stock picking, that level of risk on aggregate for the portfolio, which is public equity, about 26% of the total. We seek to outperform by 1% of our various benchmarks. So that is what we're doing. Risk-centric, quantitative portfolio construction with best-in-class asset managers across absolute return, which has limited market exposure, and public equities, where we're looking for great managers with great techniques to beat the benchmark. Second objective is to talk to you about the post allocations. I think Jared covered this well. I will just mention our absolute return target increases to 6, but we were running overweight already. Remember, you've approved ranges around our asset allocation that allow the CIO to respond to markets and respond to opportunities. We responded to the opportunity in hedge funds last year. We ran overweight. We were very successful at it. We've brought the allocation up to where we're actually running at 6%. And we would expect, if the opportunity continues, to maybe run a little bit above this 6% as part of those ranges. But we brought it to 6%. Jared mentioned that we are underweight relative to the peer group, and that is true. But that peer group, and that's a bony number, 22% of similar endowments, includes strategies that do have significant market exposure in them. Long biased equity hedge funds, long biased credit hedge funds. Those funds, which used to be in our portfolio, have moved to the appropriate area. So if a hedge fund manager has a lot of credit exposure, John Newell manages that as part of our credit exposure. if a hedge fund has a lot of equity market exposure, beta exposure, we manage that as part of our public equity long biased portfolio, leaving in the absolute return space strategies that are diversified, lower risk, and expected to do well in a variety of markets. In the equity space, you'll see the tweaks to get the total of 26% across public markets. What I would say about this generally is we're pretty close to our benchmarks. Again, the benchmark here just happened to be 22. Other endowments may be higher, a little bit lower, kind of depends what they're doing in private equity, but we're pretty much on target in our public equity space. Member Hickman noted that small and mid cap equity in the public space had gone down. And on top of that, I'll point out that we have significant private equity exposure, not gigantic, but we've been building that. And private equity is focused generally below the super large cap. I mean, certainly none of us would expect any PE funds to take Google private, for example, $1 trillion market cap. So in public markets, you have very large public companies. In the private equity space, we still get exposed to the numerous small and mid cap private companies. So we're not missing that opportunity. We've just optimized it. And we think it's more prevalent, better opportunity in the PE space than necessarily in the public space. I'd also point out that the IPO calendar, while ticking up, has been pretty miserable for a long time, and the number of listed companies has gone down. So the space has shrunk. Where it's gone is private. You should think about our equity exposures as a combination of more liquid, the public, and the less liquid, the private, and think about equities on the whole. This portfolio is largely a developed markets portfolio, and it is US-centric. It's also, to some degree, Texas-centric. Our whole business is Texas-centric. Not only are we here, we have significant oil and gas exposure. We have managers who invest in Texas. We own businesses in Texas, and we're obviously heavily involved in Texas through our work with public schools. So a US-centric developed market exposure with a decent Texas edge to it. Objective 3, how are we doing? Let's start at the top, absolute return, and I'll really your team gets credit for a lot of this. These are remarkable returns. We'd like to think we can keep them up. That is our goal, but you'll see in 1 and 3 years, we're double digit in our absolute return portfolio and well over the benchmark. Right, and that has been a good market environment and good choosing of managers, which is in the end our core job. We are an internal fund of funds. We choose managers in some of our spaces. We invest alongside them. We are good at it, and when we're good at it, we beat the benchmarks. And you see the evidence here that in this space we are good at it. 6% total asset allocation to absolute return, with a likelihood that will drift up. In public equities, 26%, you can see we are a little bit behind the public equity benchmark, 60 basis points behind. That is due to a lower risk profile. We intentionally reduced some of the risk as the concentration in the Mag 7 became extreme. We thought it was prudent to do so. Purpose School Fund's been around 180 years. We have a long view on cycles, and we believed it was prudent to bring risk down a little bit. So 60 basis points behind. Most of that has been made up in January, by the way, but we're talking through end of year this year. If you go down below, you'll see that the underperformance is largely in large cap equity, which is the Mag 7 weightings. We have beat in small and mid cap by 130 basis points over the last year and 140 in international. Those numbers are the result of very good enhanced index managers using small amount of risk to do tilts within their portfolios. So going forward, we still have a slightly lower risk profile, and we are cautious on valuations, but we believe we have managers that can beat the benchmarks and particularly can do well in down markets. And lastly, I'll talk a little bit about where we're going. So in the absolute return space, that slide. I'll use the one in front of you. The board members have a slide in front of
Yeah, they do. Diligent, page
them.
81.
So I don't have to describe it too much. In the past, we had equity and credit market data in our portfolios. That is, we would expect some sensitivity to equity and credit markets in our absolute return. We would expect less or ideally zero now. in our portfolio. In the past, we ran a higher risk benchmark. We tried to beat it by 75 basis points and did, and we used fund of funds. We no longer use fund of funds. We have saved over $4 million in annual fees by internalizing this. Our performance has improved, and our risk, as described by our benchmark, has gone down. So we're managing to a lower risk benchmark, right? We're picking funds in bigger size without the help of a fund of fund, and we are targeting lower exposure. At the bottom of the page, you'll see how things have changed over time. And Andrew, why don't you describe a little bit, particularly in equity and credit, where we had beta and we no longer have beta, how the portfolio construction
Yeah, and I would
changed.
add that the portfolio is much more concentrated than it used to be. We used to have, back in the day, over 150 line items when the hedge fund program just started. It was 5 fund of ones with very little co-ownership. And as the fund of fund relationships were wound down over the years since starting in 2016, we are now basically narrowed down to 24 relationships in the space. Even going through the exercise of reducing beta, we reduced the managed account from 60 to 24. And the average ticket sizes, the median ticket sizes of the result also has increased substantially, giving us ability to drive fee negotiations and capacity rights and everything. So we're a much bigger relationship to most of our GPs. If you see the equity allocation bars on this slide, it doesn't look like it changed much, but it did. The overall portfolio beta used to be about 0.2 to equities. Now it's virtually 0. If you look at how the underlying, it's still equity, but it used to be equity long short with a lot of managers having moderate market exposure. Now we're mostly investing in equity space and equity market neutral managers that have almost 0 market sensitivity. We've traded slightly under $1 billion in that space. So the bars look very similar, but we've redeemed out of a lot of the managers and added to several managers underneath. So there was a lot of change there. And similarly in the credit space, we've maintained some of the exposure we had in the hedge fund book, and it migrated to the credit vertical managed John, as Stu has mentioned, but kept only true long short credit managers in the space that do not have a lot of market sensitivity and sensitivity to credit risk. So it's long and short on both sides. Overall portfolio beta, as I said, both to equities and to the credit spaces.
And lastly, in public equity, you'll see an evolution here of 100% index. In the past, we were 37% public equities. That has come down as we rebalanced into other equities, private equity, where we believe we can pick up spread relative to public equities by being less liquid. In the past, we had internal management. Jared and Mr. Bunker were the 2 of the key people in the internal management of the index. No active risk, we matched benchmark. Currently, 27% of the fund is in public equities. It's externally managed, meaning we pick best-in-class managers. We expect them on a net basis to beat their benchmarks with similar levels of risk. And we have expanded where we seek risk. Remember, describe what we're doing here as being very hard-nosed, tough users of risk to drive returns. We drive a hard bargain when we take risk, and we've done that in enhanced index and active equities. I would expect as we move forward from this mix now, which is 50% enhanced index, 30% index, and a smaller portion active, that you will see our enhanced and our active grow as we find great managers who can consistently beat the market with that bias towards doing it in down market. One other aspect to what we're doing that I want to highlight, which is really broader for the PSF, but it certainly shows up here, is we collaborate across the board now. The PSF used to be highly siloed, right? People in their silos not talking to each other. Those days are gone under Mr. Borden. We sit around the table, we challenge each other. We look for the best investment. We try to get information from credit, from different areas from real estate. What does that mean for our equity portfolio, for equity managers? Where is the bias? Where do we want to go as a whole? And this is a big step forward in managing this portfolio as a whole, so we can meet our long-term objectives. We describe them as inflation plus 4 or 5, continue to grow our distributions. It requires we work as a team. And so I mention it here because it's important in equity space too. Where are opportunities? Are they in public? Are they in private? Are they in public debt? Are they in private debt? Are they in asset-backed securities? Where can we drive that hard bargain with risk? And that comes into how we choose managers and how we compare managers across them. So in closing, I will remind that the big approach on this, the reasons it's combined, is a quantitative approach. It's team in both long-only equity markets and in the hedge fund markets. We're benchmark aware, so much of our public equity exposure is still hugging benchmarks and enhanced index. We're reducing fees and complexity across the board. And as we do that, we're seeing the performance tick up measurably. Thank you. Any questions?
Questions for Mr. Billhart? Yes, Mr.
Thank you, Chair. Stu, I think of absolute return, like if I only have $1,000 and I want to get into a whole bunch of stuff. How do I reconcile that with, you could buy each of these individually, and we do, right? What we just approved was the appendix with all of the classes. Why do we have multiple approaches?
So if you think of the whole asset allocation in a big picture of trying to be absolute return at inflation plus 4 or 5, that is our goal in that note. What you see here is micro coming down to individual strategies and macro, long, short equity, credit, long, short. And it is a fair comparison, but we're just simply going from big picture down to security selection, long, short equity, misvalued securities at a micro level, misvalued securities at a bond level, long, short, equity level, long, short, or economic flows in macro. Where do you want to be long? Where do you want to be short? There are tail risks in a absolute return hedge fund portfolio. We might say, gee, if I can beat inflation by 7%, why don't we move to an entire absolute return hedge fund portfolio? And my answer to that would be liquidity, although this is a highly liquid portfolio, liquidity, and the concern, sort of risk of common holders in those types of trades. When you get a liquidity crunch and everyone runs to the exits, you could have a momentary downturn, and that is when our fixed income portfolios and other portfolios do well. So it's sort of building it up. Do we want to be absolute return in this portfolio at a micro level? Yes. And then as we get to the high level, to achieve that, I would suggest that trying to do an entire book just like this would leave you open to certain other exposures that we offset through our cash, through our fixed income. Think about our private debt portfolio. Enormous amounts of assets behind that portfolio, assets that we will seize and sell if we need to. Right? That's not true in equity. Equity can go to zero. Our private debt portfolio is highly secured, particularly the investment grade piece of it. So I think you need the big portfolio, and then we boil it down and we think about it in a micro level. Also, I point out in this space, we're taking advantage of arbitrage opportunities, relative value opportunities, really unique, high skill things that you wouldn't get with just a big asset allocation. There truly is money here that we can show and extract that we would miss if we didn't have this type of portfolio.
I would also add that typically it's trading oriented strategies, shorter term and trading oriented. And as you mentioned, it's relative value versus investment, long-term investment, right? So take investment approach and the other sides of the book. And here it's shorter term trading oriented strategies.
Would you compare that to the large cap? US equity would be a longer term, and this would be a shorter term generally.
In terms of holding periods?
Yeah.
In
Or
trading
trading philosophy or approach or strategy.
We
Active managers, so I would say active managers in US large cap, yes, they look past the next quarterly earnings, right? They're looking for next 3 years. And typically hedge funds manage to much shorter term, 3 to 6 months.
Thank you.
One last thing I will add is that PSF is on the map. It's always on the map. It was big, but when I was at Morgan Stanley, people come down to Austin and they visit the others, and maybe they come to PSF and maybe not, maybe didn't even know about it. People know who we are now. 60 billion, you know, by most measures, the largest endowment in the US, 60 billion permanent capital, AAA rated, with a great board, great staff, doing the right kinds of things in the right kind of size. People line up at that door. And it's a nice door now, so there won't a line up at that. So we're in a pretty good position here to achieve our goals.
We tell people we're in a more emotionally stable building. It used to be in a movie building. Any further questions for Stu? Yeah, a lot of good work there, and it was a little painful getting there because, you know, we had some things going on, and we some things, some cleanup in that part of the portfolio. Looks really good. Okay. If there is nothing else on that, Stu, thank you, and thank you for the good work of your team, and keep on keeping on that. All right, thank you. We're going to move on next to item number 6. We had a motion when we worked on the governance manual and related to some risk-related items, that sort of thing, and kind of came on the tail end of that. And one thing that proposed amendment, as it was constituted, was not passed by this board. But what I did do is I made a commitment to this board that we would do a study on that, and because I think that we need to. And the concern that was raised, there was the impetus for that motion is more. I will tell you that the committees, as they are constituted, were constituted at a time when we were essentially building the airplane as we flew it, you know, and a lot of that is a little bit behind us. And as we become a little bit more mature as an organization, I think it behooves us to take a look at that structure and see if it's doing what we need to be doing. And so with that, I did ask the staff to take a look at that and to come up with maybe a proposed or a draft of what that might look like, with the idea that we would continue that discussion, and we may add to over the course of the year, and then adopt that at some point as part of, because our committee charters are part of our governance manual. And then we would amend our governance manual to reflect those changes once we've sort of had the opportunity to be deliberate about that and to think through that. I will say, though, that one thing that we do need to do, and upon further reflection, I have asked the current Strategic Planning and Policy Committee. I'm going to ask them to go ahead and to assume the duty of to monitor the effectiveness and efficiency of the implementation of the strategic asset allocation, and to receive reports concerning the fund's investment allocation, performance, and associated risks. And as part of that, too, is that what we are missing in terms of policy is, we don't have a fire escape plan. We don't have a contingency plan. What happens when the financial apocalypse comes, and our peer funds do have that. And so, Mr. Kinsey, you and your committee, I think that's one of the things is that we need to look at over the course of the year, if that is something that you are willing to take on. What?
Yes, Mr. Chairman.
Yeah. Mr. Kinsey?
I just responded, yes, Mr. Chairman. I was
Okay.
answering your question.
Yeah, so kind of go through that one more time. What are we trying to do?
We're really trying
Just
to work.
real simple.
Yeah, we're just trying to work toward essentially.
Are you wanting to add another committee? Is that what you're saying?
I don't want to add another committee because.
But what are you trying to cover? What are you trying to cover?
I'm trying to work toward having a risk committee.
A risk committee.
A risk committee.
Well, let's just say it if that's what it is.
Yes, right.
So you want to add a risk committee?
Yes, but I don't want to add another committee. And so what I intend to do, what I would like to do with that is.
Why would you not want to add another committee if you want a risk?
Well, because I have a volunteer board and I think that a lot of what we can do, Cliff, is we can.
But we need to get, in something as important as a risk committee, we need to get the people in our board.
Yes.
That have the most knowledge in the investment community.
Yes.
To do that. Would you agree?
I would agree with that.
Okay.
Yeah. And what I think that we can do is that we can take some of the duties of our existing committees and we can combine them. And I think we can maintain our 3-committee structure and increase. Do that without adding more time to my volunteer board members. Lane,
Yes, sir.
you did some study on that. Can you, just in terms of what you've drafted, at least for our consideration, and I think this is just a discussion today. I want to introduce this today and what that might look like. And so Lane, why don't you?
Yes, thank you, Mr. Chairman. So in the materials are 2 draft committee charters. One we've called Administration Committee. And what that does is takes and combines the current Budget and Compensation Committee and Strategic Planning and Policy Committee. So it's literally a copy paste job. And then a few pages following that is a draft charter for a Portfolio Risk Committee. And essentially what that would do is receive reports of all the things that Jared talked about as we were approving the asset allocation. Actual allocation of the investments, risk levels, leverage, liquidity, all those things, BGP, et cetera, would be formally reported to that Portfolio Risk Committee. And again, this is noticed for discussion only. And so there's different ways to crack the nut, but this seems like a logical approach given the current committee structure that we do have.
Okay. This is a first stab at it, Cliff. I'll just say that let's continue that discussion. And if we feel like we need to move a little quicker on that, we can. We're not necessarily bound by that, but I want to go ahead. And like I said, I made a commitment to this board to take that on. I made that commitment in December and try to be a man of my word on that. Discussion.
That's something, Bob, Jared, and I are supportive of having broader dialogue with board members about what we do here. The time to discuss things is before there's a fire drill. And so we've always been keen on transparency, on sharing information, on educating board members, on giving input. The notion of 3 committees, one for corporate governance, one for portfolio oversight, not decision-making, oversight, knowledge of what we're doing and why, and one for compliance and audit makes sense to us as sort of 3 distinct functions. But in the interim, we believe it makes sense for policy to take this on. We have things we'd like to work through with board members. Mr. Kinsey has been very active and value added to us in this process. We have regular meetings. And so Bob felt that committee with the chairman's support would be a good starting point until such time that the board can deliberate and decide if these other 3 committees are a better way to go. That can't be done quickly. We are interested in having creating more transparent, having integration with the board members who are interested in the portfolio.
But don't we parameters, risk parameters for you guys to follow?
We do, but
Established
risk
and
is, as we discussed earlier, risk is more complex than that. Discussing asset allocation, what's going on, how we see the risks, how we're gonna construct the fire drill, the contingency plans for generating cash. We feel all those things are better done with some board involvement along the way.
What's your take on that?
Yeah, I think what Stu's touching on here, to the extent you sort of manage the expectations and understanding cost transparency upfront before there's a problem. Because, you know, this is $60 billion fund, it's invested in the capital markets. All the thing I can say for sure is eventually there will be a problem. The markets will go down or some aspect of the market will change and whatever, we'll be here talking about it. To the extent all of that was covered, call it whatever committee, risk committee or subcommittee, whatever you want to call it, that's been sort of dealt with well in advance. And I don't mean months in advance, I mean sometimes years in advance, have been talked to, thought through, developed, all the better, right?
And I think too is that I think that you know, examining and stress testing your processes and your policies and things that is something is an ongoing process. You know, it's the market changes every day, and so those things are, you know, but it's I think it's pretty much industry practice that the most boards do have a risk committee. Is that fair?
The boards of your size, you know, institutions of your size, Robbie size, would have some sort of a committee or something for risk. Risk is, I think what Stu was saying is risk is, he was defining it differently, but you think risk is sort of ex ante and ex post, meaning was forward looking risk, like asset allocation. You look at it and there's ex post, which is part of what I see up here in these guidelines in this charter is sort of backward looking risk monitoring. So looking at the portfolio on a quarterly basis with your risk committee, see how you did. So that by the time you get in here, if there's a question, there are 2 or 3 members of this board have already delved into that in detail and can step in and answer those questions and give it some transparency and some support to the broader board that, oh, okay, well, this has been looked at.
Yeah, and in no way, and again, I think I'd hasten to add is, and in no way are we suggesting that the members of this board are going to be trying to micromanage, you know, day-to-day operations or investment decisions. I mean, these specific investment decisions is that that's not what risk is about.
Mr. Chairman, I just wanted to add a couple of observations to help frame some of this. I'll refer back to the earlier life cycle timeline I was talking about, the kind of the 3 big columns where we are getting to the end of the beginning, setting a lot of structures in place, and now we're entering into this, you know, really refining in action, you know, our plans. To that end, internally established an investment performance and research committee earlier this year, and in the middle of this year, a risk committee, middle of last year, an internal risk committee. We weren't in a position to do anything like that until we got a new risk system put in place. We had to migrate off of the old Latin program. We got a new system installed. We had to spend a lot of time populating it with scads of data. I mean, the number of data elements is staggering, and it has to be done right. Otherwise, you've got garbage in and garbage out. And we were just getting to the point where internally we are now able to start viewing these things and develop risk reports. Then when this 2 things came up, member Thomas asked about the escape plan, because emergency plan. And that is something that's going to take a lot of iterations that really deserve to be talked about in a committee structure, because it's going to be work in progress. There's going to be some things we don't necessarily want to telegraph to the street either that we plan to do. So you know, having a venue for that was important. But this credit rating thing really brought it home. In September, we were looking at potentially heading towards a downgrade or watch list on the bond guarantee program. And the staff was facing a choice then, because our mission has a built-in dichotomy to it. The distributions and returns argues for marginally higher risk, marginally more illiquidity. The BGP part of it argues for lower risk and higher liquidity. And we were about to be facing a trade-off of, you know, which is going to trump the other? Are we going to try to slow down the bond guarantee program, or are we going to de-risk the portfolio? And at that moment, I realize this is absolutely a board decision if we have to do it. Because we are trying to pick what side of the mission we're going to favor. Most fortunately and mercifully, through all the work of the risk group that we talked about a lot, we have gotten significant relief from that, a lot of headroom, but it's still out there in the background. And this is another item that we will have wanted to have that discussion long before we get there. And again, probably deserves a committee setting to do that. So I do believe we, have a reason to want that kind of home. I will underscore though, we are at the very beginning of being able to even generate relevant reports. So the course of this year is going to be, sausage making, for lack of a better word. But we're going to move on with this day in and day out, no matter what. The question is, what's the most effective way for us to, communicate the outcomes of these things to the board? And, is there an interim step that heads towards a more permanent step? And maybe I'll outline last time the notion of why there might be a collapsing of these two committees has to do with that 3 stages. There was such upfront build-up out work that had to be done by the Compensation and Budget Committee to come up with a comp plan where there was none. And it was a heavy, heavy lift. And to come up with our first, appropriations process where we had no process, heavy, heavy lift. And in the Policy and Planning Committee, we had to come up with all of these policies, including that governance policy out of thin air, which was a heavy, heavy lift. I expect the workloads on those committees in the middle part of our life cycle to be much lighter. And I'm philosophically, I believe that planning and budget belong together as a function and a discussion item. So it really lines up nicely that after we get this year's appropriations request done, maybe we're at a point that it does make sense to merge those 2 committees. You've also got at least 2 new board members that'll come on at the end of next year, and we'll be faced with kind of reconstituting committees. So that's kind of where we want to head. The question is, where's the outlet to do some of this sausage making between now and then?
Discussion item, yes, sir.
I don't know, Lane, if this is for you or someone else. And what I'm thinking of is a risk committee. I don't know exactly what it does, but it finds out something is super high risk and wants to change something. How does that fit in with the governance manual? So is there authority currently for this risk committee to do anything? Or would that have to be, we have to go back and look at the governance manual and see what it is the risk committee would be doing and what authority it has and how that all kind of fits together?
I want to interject, even though it's a legal question.
No,
We
absolutely.
purposely structure these committees that they are not decision-making bodies. They're deliberation workshops that always go up to the full board for whatever action they want to take. So I would think it would be very consistent with that. If they identify, okay, we have a push point here that means a policy change needs to occur, that the full board will always consider that. None of these committees have ever taken actions on their own. They're not empowered to. The charter doesn't allow for that. And I would see this to being the same thing. All it ultimately does is it can recommend actions to the board if warranted. But the full board is the only body that can change some of those high-level policies.
I'll stay there. So thank you, Bob. So that would be a recommended change to the investment policy statement to account for this risk, whatever. Is that how you see that?
No, I think it's a change to the governance policy to establish this risk committee.
No, I think the question is that,
Oh,
so the committee would be making what kind of recommendations that would result in what action by this board?
Exactly.
yeah. Now, talking about the committee that exists right now that we're trying to piggyback on, that was the policy committee, which all policies have traveled through to make it to their way to the board. So most likely anything that ever came out of the risk committee that required a change in policy would almost certainly be the investment policy, the broader policy, including all the appendix.
Okay.
It wouldn't be like an ethics policy or a governance policy change. It'd be an investment policy change.
And I guess back to my original question, does this board then have authority to make risk-related changes to something through the governance manual, or is that something new?
Well, that would probably be in the asset allocation.
Yeah, you just
Yeah.
made some today
You just
by
did
putting
it today, yeah.
a leverage limit where there was none.
Okay, so that was part of the investment
Yes,
policy.
yeah,
Okay.
yes.
Got
That's
it.
a yes.
And I would think of this as an interim solution as we construct the risk parameters of dialogue. It's not decision-making, it's oversight. We work with policy and you work towards at the end of the year saying, okay, we've learned enough, we've evolved enough. You know, the corporation has become more developed, you know, we're a few years old and you go to these 3 committees. So there's no rush on it. Jared and I take the lead on this. This gives us a venue with some board members to start working through these.
I'll say one last thing too. I have used the CEO comments in all committees as an opportunity to make sure that board members were hearing other things that were in the back of, and I'll refer to the BGP. We didn't really have a committee home for that. Every single committee heard it. And I will continue to do that whenever we have some new and growing issue. It just helps that the more that all the board members are aware of pending issues, the better off we are in, you know, discharging our duties. And of course, the staff is going to serve however many committees the board sees fit to make. We're making some recommendations basically because of the chairman's observation that it is kind of a burden on a volunteer board to have, you know, a proliferation of committees. And there's this one opportunity, I think, to collapse one that does make sense to me, but that must make sense to the board too.
It's just a discussion. We're just throwing it out there, and we'll continue to have this discussion, and at some point, and if we feel like we need to move faster, we will. If we need to take a more deliberative, we'll do that as well.
That's good.
Mr. Hickman, this draft charter in 1C says this committee would review and recommend to the board the strategic asset allocation and IPS. And so we can certainly tweak and add that, recommend to the board other things as well, but that's a pretty broad umbrella in my reading.
We have some time to work on it.
And we'll need some time.
And what we'll do is that as we work through the year, we may find a few other things. Migrate here and there, that sort of thing.
In terms of goals, Mr. Chairman, I think you and I discussed that we should have a goal that by the fourth quarter meeting, we have a solid approved set of charters and amendments to the governance policy to reflect that. So we'll probably have to talk about it during Q2 and Q3 to get there.
Yeah, I think my intent would be then to have a proposed draft of those amendments at the third quarter meeting, and to give everyone a little bit of time to, you know, we don't want to spring it out at the last. And then if everybody's good with it, we'll adopt the fourth quarter, and then we'll first quarter meeting of 2027 will be minutes.
Mr. Chairman, just 2 questions on that. Considering, number one, where is the discussion happening? Is that internal, the agency? And then this discussion that's going to be ongoing about this, who's having those discussions?
On this board.
In the committees that are currently?
We're having a discussion right now, and we will have that discussion next meeting as well.
Okay, so at the board meeting, so there'll be an item on the agenda for discussion about some of that. And then in the meantime, then I guess is the risk assessment for a better word, looking at that. Is that still going through the strategic planning committee then?
It's going to be a focus, but we'll also update all the committees on that as well. And Bob is going to essentially, you know, brief all committees to that extent, but have a little more focus on at the in strategic planning, essentially because is that they will be also taking on essentially the policy that is kind of our fire escape anyway. And being that is a discussion that they're going to be having, because during the course of 2026, by the time we get to the end of 2026, we need to have that plan very close to completion. And so that's going to be a big project, and certainly these discussions are kind of part of that.
I think in the next few months, or you'll see Jared and I begin to have regular, relatively probably monthly engagement on the kinds of risk reports we have, the kinds of data we have, the starting to create that transparency to get a feel for where we want to go, thinking about sort of end of the year if we arrive at committee review. And that will be with members of the policy committee, going into the details to discover together, go back to our values at the start, transparency and honesty and openness. And as I said, the board is part of that team on those issues. So Jared and I will be reading that on a regular basis.
Yeah, I was just thinking to understand we're having some of this discussion now, an open meeting and all of that, but that some of this would have to happen in committees.
And we just sprung it on you today.
Yeah.
But we're not springing it on you to adopt it. We're springing it on to you to have that discussion. And I think that as we continue to have committee meetings and such, we will probably tweak this draft a little bit. It's like, oh yeah, we didn't think about that. Let's plug that in there. And I think this is going to be a living document. And by the time we get to quarter 3, though, we need to have kind of an idea and maybe kind of present that as a almost a first reading, and then with the idea that we can get to the fourth quarter and this board can feel pretty good about it, and we can adopt it and then move forward. Okay. If there's anybody else have any discussion on that? Any thoughts? Okay. Members, one of the duties of this board is we are required to do a evaluation of our executive leadership. And with that in mind, we're going to a closed session, a closed executive session. And so we will do that to take up agenda item number 7 to discuss personnel matters related to the chief executive officer under the government code sections 551.071 and 551.074 to deliberate personnel matters and to consult with legal counsel as needed. The closed session will be held in the Legacy Boardroom, room 755. The meeting will resume on the conclusion of the closed session. The time is now 1:22.
Mr. Chairman, for the members who are attending virtually, you don't have to do anything. You will be virtually moved to that room. So just stay on the line where you are. We'll move you. Okay. Okay. The closed session of the meeting of the Board of Directors of the Texas Public School Fund Corporation on February 19th, 2026 has now ended, and the board is now in open session. Time is 2:01 p.m. No action was taken by the board in closed session. Members, we have just a few more items to finish up here, and we're going to start with just the committee reports. And Chairman Wright, I think that you're up first, and followed by Mr. Kinsey, and then Dr. Ellis. Okay, Mr. Wright. Budget and compensation.
Yes, the Budget and Compensation Committee met. All members were present, met with the team, heard Bob give CEO remarks, general overview. We talked about the upcoming evaluation process on the compensation front, and then spent a lot of time on the budget and the upcoming LAR process, and looked at actuals to budget and variance, and all is in good shape on that front, and still heavy lifting to do on the LAR, but making good progress. And that's it.
Any questions for Mr. Wright? Okay. Thank you. Chairman Wright, thank you for your leadership on that. Chairman Kinsey.
Thank you, Mr. Chairman. The Strategic Planning Policy Committee met on Thursday, February 5th at 2:30 p.m. We had everybody in attendance. Just to recap, that's Commissioner Buckingham, Member Perez Diaz. We heard from Bob, similar to what Brad discussed earlier. We also looked at the strategic asset allocation benchmarks, and revised IPS that we covered in item 4 of today's agenda. We got an update on the strategic plan from Needy and the refresh that's going on with that, including centralized framework to help measure goals and the impact achieved. This new KPI framework will shift board reporting from activity-based updates to outcome-driven performance, and we had an early look at the progress made against the strategic plan thus far in 2026. Finally, we closed out with a review of the proposed agenda and the projected calendar for the upcoming meetings, as I understand was done in the other committees. And that was it. No action was taken.
Any questions for Chair Kinsey? Chair Kinsey, again, thank you for your leadership on that. Audit and ethics.
Thank you, Mr. Chairman. The Audit and Ethics Committee met Thursday, February 5th at noon. We heard remarks from the CEO. Mr. Borden provided an overview of the status of the corporation, update on the bond guarantee program, similar to what was discussed in his remarks earlier today. Our second item was an annual audit plan report for 2025. We had KPMG, and they reviewed our annual report for the year ending August 31st, 2025, and they had no findings in their report. Item 3 was our CAO remarks and updates. This was covered by Brad as well as Bob's CEO's remarks. Item number 4 was our annual compliance update. The corporation is at 100% of the required reports with no conflicts of interest or other concerns. Committee also reviewed the annual log of director referrals, which is included in diligent materials. And members, if you'll remember that we are now tracking that if any referral is made from a director, and you can go to your diligent material to see a running log that is kept up on any of those. Item number 5 is cybersecurity update. We finalized the annual cybersecurity report. We achieved full training compliance. We passed Q4 penetration testing with no high-risk findings. We assessed 49 cloud vendors for security and all met or exceeded best practices. We will be shifting from quarterly committee updates to semi-annual committee updates on our cybersecurity. And lastly, we also reviewed our proposed agenda and projected calendar, and I believe we still have that further discussion upcoming in our next board item coming up. And that's all we had.
Any questions for Dr. Ellis? Dr. Ellis, thank you. A lot of good work there, and and they do a lot of heavy lifting over there as well. So now we need to. I'd like to draw your attention to the next item, and that is the discussion and action related to board self-assessment. So when we passed our governance manual, is that it requires us to have a board self-assessment. This is about process improvement. And Lane, will you kind of highlight that in terms of what we have available to them? I think it's going to be an online instrument. Is that correct?
Yes, Mr. Chairman. So if you'll recall back to the December meeting, we adopted the governance manual. One of the things the governance manual specifies is a process for board self-assessment. And so what we have in mind here, there's a 2-page document, page 96 and 97 and the diligent materials. And what we're going to endeavor to do is to build an online survey where you can check 1 through 5, 1 lowest, 5 highest. We'll add some comment boxes there. So for example, if you do give a low score, we would love to understand why so that we can improve things. And then there's a question at the end, what educational resources or training would you find helpful to facilitate your board service? And so keep an eye out for that. We're gonna try to populate an online survey, send that out to all the board members, and then look for those completions. And of course, we're open to suggestions if there's different or better questions that we could ask.
Be brutally honest, and again, is that if you score something low, give us some suggestions where we can close the gaps and make things better. The training piece, I want to just kind of draw your attention to that. One of the questions I asked Bob is that I know that the staff here all receive reading material to help them keep abreast of what's going on in the markets and such like that. And if we could have access to that, if we so desired, and think about that, and if that is something that you would find helpful to you, And that way that you can keep up. And the other piece of that is that each one of us come to this board with different skill sets and different backgrounds. And if there is some training that you would find helpful to help you become a better board member, to better understand what is happening here, whatever that might be, is that we would like to really know what that is. And so we can tailor some board training to you as an individual board member rather than just the board as a corporate body in general. Rhett, I know that y'all have some resources on that at NEPC. You want to comment on that?
Oh, well, you can handle it in a couple different ways that I can think of. One is external educational opportunities like NCPERS. I know you're not a public pension, but 90% of what they do there is sort of investment related. So there's a lot there in terms of these different conferences. A lot what you find are NCPERS. There's 2 conferences a year, and they're usually really phenomenally well done in terms of fiduciary education, investment education. The other is more directive. So you certainly work with staff, put together investment tutorials or fiduciary tutorials specific to be for a smaller group or for the entire board.
Yeah. And so anything that you think that you would find helpful to you in terms of fulfilling your service as a board member, please let us know that and let us work with you on an individualized board training plan that would help you do that, because each one of us are a little bit different, in terms of where we came from and how we arrived on this board. Any questions on that? All right, well, members, we have thank you for your time. And this has been a little bit longer meeting, but we covered a lot of ground, and thank you for your service. I'm sorry. We have not received the end of our, yes, I was Mr. Kinsey, I was speeding. And so, item 12, discussion and action regarding the upcoming agenda and calendar. Bob.
Thank you, Mr. Chairman. Members, I'd like to propose an adjustment to our new meeting cadence. Recall that last fall, the notion that we not have our committee meetings the day before the board meetings as we were having in 2025 was brought up. And we ended up centering on, at my recommendation, that we go to 2 weeks before the board meeting. That has turned out to have some unintended consequences that I won't elaborate on, but it's not a very workable. And I would propose that we go back to the framework that we used in 2024, which was on the Wednesday, the week preceding the board meeting, we would have the committee meetings. And to that end, we have a calendar that reflects that for Q2 and Q3. Recall further, though, that we had a very kind of unorthodox calendar for December when we were only looking at 1 day. We had scheduled the board meeting for the week immediately after Thanksgiving. And if we were going to have a committee meeting before that, it was going to then fall on Thanksgiving. But 2 weeks before was the State Board of Education. So we had set it for 3 weeks before. I'm proposing now that we move the board meeting proper to the second week in December and have specifically December 10th, and have the committee meeting then the week before, which is Wednesday, December 2nd. So if the board is amenable to that, we'd like to ask for a motion to approve it so we can schedule it accordingly.
Recommendation. So the recommendation is that we reschedule our committee meetings to the Wednesday prior, and then December would be, and in order to effectuate that, the December meeting the board meeting would move to the 10th, Thursday the 10th. Okay. Care to make that motion?
Sure.
Motion from Cliff Thomas. Is there a second?
Second.
Any discussion? Any debate? Any objection? Hear no objection, motion carries. Thank you. Now we reach the end of the agenda. Thank you, board members. I think you're doing great work, and thank you for what you do. I know that you give your time willingly and to do a great mission, and thank you for what you do, and thank you for your participation. We will stand adjourned.